Check. Can you guys hear me properly? Sound check. Sound check. Sound check. Okay. Good evening, students. We'll very quickly start with the stream, and let us start with our today's session. Okay. Good evening, everyone. Okay, my dear. If there is any problem in the audio, so do let me know. Okay, we can fix that up. Okay, good evening, everyone. Okay. Let us now start with our today's session. And my dear students, today, as we have discussed, we will be dealing with all your past 8 exam papers. Okay, so good evening, Varshini. Okay, fine. So my dear students, today we are going to discuss about your inter CA financial management, your past 8 papers, in which we'll be discussing all the questions, what should be the approach, what should be your exam strategy, what should be tips, tricks, etc. Everything. I just want you all to be with me throughout the entire video. You can keep your notebooks handy and keep your calcs, so that whenever the calculations are required to be done, whenever you have to give any answers, then you can give the answers accordingly and we can proceed further. So this particular session is going to be extremely helpful for you if you are preparing for your September 26 examinations or beyond. And we'll be discussing lots and lots of questions here. What should be the approach? What should be the steps? What should be your interpretation and everything? Okay. So I'll try to keep the entire video majority in English language only, so that students across the country can understand all these particular concepts very thoroughly. Okay, so now my dear students, if you have any doubts, difficulties, then the chat box is all yours. You can ask your doubts, difficulties, etc., everything in the chat box. But before we start with this particular video, I'm very sure that there are some VIVITSU students also who will be watching this particular video, if not now, definitely at a later scale. And VIVITSU has prepared a wonderful textbook, and this particular textbook for financial management, I personally like it a lot. They have lots and lots of organized way of the questions and the solutions, which has been kept from RTP, PYPs, and all those things. So definitely you should consider this particular as an option if you're preparing it in a much better way, on how you will be discussing all the concepts, questions, etc. in a very organized way. Everything is being specified with the ABC analysis. So I'll be referring to this particular textbook for your ABC analysis, and also for some important exam insights also. So as you guys can just check, in our VIVITSU book also, there are some exam insights which are given to you at regular intervals, that what is the examiners or what is the paper checkers opinion about a particular question, what are they expecting from you. So that is very important. So my dear students, when we are going to refer to this particular any examination paper, then I will pay special emphasis on what are the examiner's insights as well, so that you will also come to know that what type of language is to be required, how you have to approach the question, and how you have to solve it. Okay, so as I was saying, that we would have prepared all these things on chapter wise basis. And let's say for example, if you're talking about ratio analysis, then in ratio analysis you will see all the questions from the past examinations which has been specified here. Okay, so some very good questions along with ICAI solutions have been specified, so you can definitely consider it. And I will definitely let you know more about which all questions are important and how we should approach the particular question, etc., along with the examination insights as well. Okay, but first thing, my dear students, we are going to start here with your May 24 paper. Okay, so our objective is very clear. Refer to all the questions, okay, including the theory part. So we'll be also referring to the theory part, my dear students. Case studies and MCQs, I am planning to keep this towards the last. If our time permits, then we will do our case studies and MCQs also of all the papers right now. If not, then we will prepare a special video for case studies and MCQs. But right now the objective is to complete the entire questions for your inter-CA financial management starting from May 24 onwards. Okay, so let us now quickly start. So this particular paper which is there in front of me, that is for your May 24 examination. Okay, now as you all know that in your descriptive questions, which is for 35 marks, your question number 1 is compulsory and we have to attempt any 2 questions out of the remaining 3 questions. Okay, so your first question is your compulsory question, and then from your question number 2, 3, 4, you have to attempt any 2 out of the 3 questions. Okay, so now my dear students, first let us start with your very first question on what is given to you. Okay, and I'll be presenting the question as well as solution, and wherever the important points are there, I'm going to highlight it and you can make a note of that as well. So all these things we are going to discuss, but let us now first start with your question number 1A. See what is given to you in this question number 1A, that Team Limited provides you the following information, in which we have debt of rupees 45 lakhs. Okay, and there is 12.5% debt which is being given to you. Okay, along with that there is a debt to equity ratio, okay, which is given to you as 1.5:1. Okay, yes Varshu, I have received your message from Chennai batch and I wanted to revise today so it will be more effective. Yes, definitely Varshu, this is definitely going to help you for your preparations of your examinations also, and all new questions, all the updated questions, etc., will be referring to it, so you will really enjoy. So please be with me throughout the entire video, okay, and solve along with me. Okay, so let's continue this further. So what is given in this particular question? So see, we have 12.5% debt which is amounting to rupees 45 lakhs. Then we have debt to equity ratio which is 1.5:1. Okay, so debt to equity ratio, my dear students, that is debt upon equity, which is given to you as 1.5:1. Return on shareholder funds is available as 54%. Operating ratio is given to us 85%, and ratio of operating expense to COGS, that is given to you as 2:6. Your tax rate is nothing but 25%, and your fixed assets amounts to rupees 39 lakhs, and your current ratio is 1.8:1. So you are required to calculate interest coverage ratio, gross profit ratio, and current assets. Now, whenever you have a question like this, the first thing you have to understand is, sir, what are the list of formulas which you have to understand? So the first part is interest coverage ratio. So my dear students, what is your interest coverage ratio? As you all know that your interest coverage ratio is nothing but EBIT upon interest. So it will help you to understand that how much number of times your interest is getting covered from the amount of operating profit. So just to give you an example, suppose your EBIT is 1 lakh rupees and your interest is 10,000 rupees. So can I say your interest coverage ratio is nothing but what? 10 times. It means that you can pay 10 times interest with the amount of your EBIT. Okay, one very basic thing. So EBIT upon interest, that will give you your interest coverage ratio. Okay, and this should always be higher the better. So whenever you see such kind of questions, now first try to understand what is going to be the ratios attached to it. The second ratio which we have is your gross profit ratio. So as you all know, what is the formula for your gross profit ratio? That is nothing but gross profit upon sales into 100. And then, my dear students, we have something which is also called as current assets. So we are required to calculate the current assets. So for that, we have to take the help of the balance sheet to calculate what should be your amount of your current assets. How should you approach such kind of a question? So the first thing is, my dear students, we should always start with the ratio in which the figures are given to you. So here, as you all can just check, there is debt to equity ratio, which is 1.5, and we have the amount of the debt, which is 45 lakh rupees. So then, my dear students, as I am telling you, the debt equity ratio, that is nothing but 1.5 upon 1, okay? And we have the amount of the debt which is available, that is nothing but 45 lakhs. So can I say this is 45 lakhs? Can I calculate the amount of my equity? Come on, yes or no? Yes, sir. So what is going to be my amount of equity? So if I take 45 lakhs and divide that by 1.5, so my amount of equity is nothing but 30 lakhs. So then, my dear students, I should first get what is the amount of equity. What do you mean by equity? So your equity is nothing but your shareholder funds. Okay. We can also say that this is nothing but your equity shareholder funds. There is no presence of preference shares in the capital structure. So can I put it like this, that your equity shareholders funds and your shareholders funds are nothing but the same. Okay. So we have, my dear students, your equity shareholders funds or shareholders funds, which is nothing but amounting to rupees 30 lakhs. Okay. So we have, first of all, your equity or equity shareholders funds or your shareholders funds, which are readily available. And then, my dear students, we also have return on shareholders funds. Now, how do you calculate your return on shareholders funds? So your return on shareholder funds, or also known as return on equity shareholder funds, because here there are no preference shares in the capital structure, is nothing but what? It is nothing but net profits after tax minus preference dividend. Divide that by equity shareholder funds upon 100. So which is nothing but net profits available for equity shareholders. Divide that by equity shareholders funds into 100. Will that give you a return on equity shareholders funds? Come on, yes or no? Yes, sir. Okay. Now, my dear students, what else is given to you? So once we have the return on shareholders funds, which is 54%, and I have the equity shareholders funds amount available, then can I say I am in the position to calculate what is going to be the net profits for equity shareholders? Come on, yes or no? Yes. So my equity is nothing but 30 lakhs. And if I multiply that by nothing but how much percentage is this? 54%. So I will come to know 16,20,000. Is that nothing but my net profits for equity shareholders? Come on, yes or no? Yes, sir. So now, if you guys can just check the solution also simultaneously, you will come to know that your net profits after tax is coming as 16,20,000. Okay. Now, my dear students, can we go reverse and do the other calculations also? Come on, yes or no? Yes. So as you all are aware that from EBIT, if I subtract the amount of interest, what do I get is EBT. From EBT, if I subtract the tax, what I get is my net profits after tax. Now, because there is no preference share capital in the capital structure, can I say your net NPAT appears to be 16,20,000, and there is no preference dividend. So net profit for equity shareholders itself is your net profits after tax. And now the tax rate is given to you as 25%. So in this particular case, can I say if this is 100, this is 25, this will now become 75. So what should be your amount of EBT? So my dear students, your amount of EBT will be what? 16,20,000 into 100, divide that by 75. That appears to be 21,60,000. So this is the amount of the EBT. And do we also have the amount of your interest? Yes or no? Yes. From 45 lakhs, if I multiply that by 12.5%. So 45 lakhs, if I multiply that by 12.5%, what do I get is 5,62,500. So my dear students, I am now having interest of 5,62,500. And what is the amount of your EBIT? So that turns out to be nothing but 27,22,500. So now once I've got the EBIT available, am I in the position to now do the other calculations? Come on, yes or no? Yes, sir. So I have the EBIT available. So once you have the EBIT, my dear students, the next thing which we have to do is we have to do the interest coverage ratio. That is EBIT upon interest, as I've mentioned. So we have the amount of EBIT, which is 27,22,500. We also have the amount of interest, which is 5,62,500. If I divide both these things, then 4.84 times, that is nothing but interest coverage ratio. That's the first part. Now, my dear students, the second part of the question is we are required to calculate the gross profit ratio. Now, gross profit ratio ideally means gross profit upon sales into 100. Do you have the amount of your gross profit available right now? No, sir. Do we have the amount of sales available? No, sir. So now how can we approach this kind of a question? Now, in this particular case, my dear students, we have up to the extent of EBIT given to you, and we have operating ratio available. Now, I would like to pay emphasis on the difference between what is your operating ratio and what is operating expenses. Okay. So, first of all, is there a difference between operating ratio and operating expense? Come on, yes or no? Yes, sir. Now, what is the difference? If I tell you that sales less COGS, that gives you GP minus operating expenses, if that gives you EBIT. Now pay attention to this very, very, very carefully. Suppose my sales is example 1 lakh, my COGS is example 60,000. If my gross profit is 40,000, and if my operating expenses is example 20,000, then can I say my EBIT will be 20,000? Come on, yes or no? Yes, sir. Now, if I'm talking about your operating ratio, so your operating ratio, my dear students, is nothing but whatever is 1 minus operating profit ratio. 1 minus operating profit ratio. So what is my operating profit ratio? Whenever I'm dealing with my EBIT, I am talking about operating profits. So if I take my EBIT and divide that by sales into 100, what I get is nothing but the operating profit ratio, which turns out to be 20% in my case. So 1 minus 0.2, what is my operating ratio then? 0.80. So my operating ratio comes as 0.80 or nothing but 80%. Come on, yes or no? Yes, sir. But when I'm only dealing with my operating expense ratio, then in that particular case, it is 20,000 upon sales into 100. So whatever is your 20,000, you divide that by the sales of 1 lakh, multiply that by 100. So your 20% will be treated as your 20% will be treated as your operating expense ratio. So what was your operating ratio? Your operating ratio was 80%. What is your operating expense ratio? That turns out to be 20%. So is there a difference between operating ratio and operating expense ratio? Come on, yes or no? Yes, sir. Now, my dear students, in this question, what is given to you? They have told you there is operating ratio of 85%. Now, my dear students, when they have given to you operating ratio of 85%, it means that my operating profits is going to be what? Can I say my operating profits is going to be 0.15? Because 1 minus 0.85, will that give me 0.15? Come on, yes or no? Absolutely yes. So when my operating ratio is 85%, obviously what is the operating profits? It's nothing but 15%. Okay. So now do I have the amount of the operating profits which is EBIT given to you? Come on, yes or no? Yes, sir. What's the EBIT which is given to you? 27,22,500. So now, my dear students, what is the formula for operating profit ratio? Can I say my operating profit ratio will become EBIT upon sales into 100. What is my operating profit which is given to 15%? So this is nothing but 15 is equal to, do I have my amount of EBIT? Yes, sir. 27,22,500. And then I will divide that by the amount of sales into 100. Am I in the position to calculate the sales? Come on, yes or no? Yes, sir. If you are also doing calculation, then please write down the answers in your chat box. That will be coming as how much? It will be coming as 27,22,500 into 15. I have to divide that by your 100. Now, what is the amount of the sale? So this is nothing but my operating profit is coming as 15%. Okay. So this will now be 27,22,500. Divide that by 15. Multiply that by 100. So this will be coming as 1,81,50,000. So now do I have the amount of the sales which is 1,81,50,000? Come on, yes or no? Yes, sir. So I am now having the amount of sales available as 1,81,50,000. Okay. Now, as you guys can just check, if I have the amount of sales available, which is 1,81,50,000, now I can definitely proceed further and do the remaining things. Because for GP ratio, I need gross profit upon sales into 100. Do I have the amount of the sales available? Come on, yes or no? Yes, sir. 1,81,50,000, which I've just now calculated. What I actually need is the amount of gross profit. How do you calculate the amount of the gross profit? Now, for that, they have given to you in the question the breakup of ratio of operating expense to COGS, which is coming as how much? 2:6. Okay. Now, my dear students, we have to find out what is the ratio of operating expenses to COGS. As I've just now specified that your sales minus COGS gives you your gross profit, from which if I subtract the operating expenses, I get the amount of EBIT, right? Do I have the amount of EBIT? Yes, sir. What's the amount of the EBIT? Which is 27 lakh 22,500. Okay. Can I say COGS and operating expenses both to put together will give me the total operating cost? So if I take my COGS and if I add the operating expenses to it, what I will get is nothing but my total operating cost. Now, as you all can just check, if I have operating profits available, which is nothing but 27 lakh 22,500, and if I have what is the amount of my sales available, so obviously, can I say from my sales, if I just subtract whatever is my operating profits, will I get the total operating cost? Come on, yes or no? Yes, sir. So what was the amount of the sales? It was 1 crore 81 lakh 50,000. What was the operating profits? 27 lakh 22,500. Now, what is the amount of the operating cost? Just calculate this. So this will be now coming as 1 crore 54 lakh 27,500. Now, my dear students, I have the breakup of COGS plus operating expenses, which turns out to be 1 crore 54 lakh 27,500. I need a breakup of this. How much is my COGS and how much is my operating expenses? Now, do they have the breakup available in the question? Come on, yes or no? Yes, the breakup is 2:6. So now in this particular case, if the breakup is 2:6, what was 2 here? 2 is operating expenses. So my 2 is operating expenses. Okay. What is 2? 2 is my operating expenses and my 6 is COGS. So obviously this is nothing but what? 3:1. So now can I say I can bifurcate this by taking 3/4 and 1/4. So if I divide this by 4, I will be getting 38 lakh 56,875. And if I multiply this by 3, I'll be getting 1 crore 15 lakh 70,625. And then, my dear students, once I have COGS available as well as I have operating expenses available, now can I calculate my gross profit? Yes, because sales minus COGS will give me my gross profit. So what was the amount of the sales which I had? 1 crore 81 lakh 50,000. And from this, the amount of COGS is 1 crore 15 lakhs 70,625. Will I be getting the GP? Come on, yes or no? Yes, sir. So now my GP will be nothing but 65 lakh 79,375. And once my GP is available, can I substitute that in the ratio to get the amount of my GP? Come on, yes or no? Yes, sir. So as you guys can just check, we have already calculated your gross profit, which is coming as 65 lakh 79,375. Divide that by the amount of the sales into 100. So that turns out to be 36.25%. So this question is too lengthy for a 5-mark question. Okay. But the process is very simple. And the biggest takeaway from this question is what? What should be the difference between your operating ratio and operating expense ratio? Can I say operating ratio is nothing but what? 1 minus operating profit ratio. So COGS plus operating expenses, both together, will it be forming part of the total operating cost? Come on, yes or no? Absolutely yes. And once you have the total operating cost available, from that, then you have to do the bifurcation of operating expenses and your COGS. And once that bifurcation is done, okay, this is the operating expense, this is the COGS. Sales minus COGS can give you your GP. And then, my dear students, we can find out what is your gross profit ratio. So this is in fact a very, very, very important part which you should know. So there are certain questions in which I will invest more time to solve. And one of this is luckily your first question which we are solving, so that you will come to know that we need to take into consideration all these things. Okay. And then only we will have the final answer which is available, which is coming as your gross profit ratio. The next thing which we have here is, my dear students, something which is called as your current assets. Now, how do you calculate your current assets? So for current assets, my dear students, I'm just preparing, in a very short way. Now, this is something which you'll be able to very easily crack it. If I have equity share capital, and then after equity share capital, my dear students, if I have your debt also available, and then equity, debt and current liabilities, this together will give my total of the liability side. On the asset side, I will have fixed assets, and then I will be having my current assets. And total assets of fixed assets plus current assets will give me my total of the asset side. Now, which all figures are readily available? First, we should substitute that. Now, do we have the debt available? Yes, sir. How much is that? 45 lakhs. Okay, no problem. We have the amount of the debt, which is 45 lakhs. Equity, we have already calculated in first part, which turns out to be 30 lakh rupees. Okay. Then, my dear students, do we have your fixed assets available? Yes, sir, which is nothing but 39 lakh rupees. Now, how do we calculate your current assets? So for that, we have something which is called as current ratio. What is current ratio? Varshu, we have current ratio, which is current assets upon current liabilities, and which is nothing but 1.8:1. Okay. So this is 1.8:1. Now, my dear students, can I say that my current assets will now become 1.8 times current liability? If I take current liability here, can I say my current assets is nothing but 1.8 times the current liability? Come on, yes or no? Yes, sir. Now, this current assets is 1.8 times the current liability, and this is nothing but your current liability. Now, we can have the total of liability side, which is nothing but 30 plus 45 lakhs, which is, can I say, 75 lakhs plus current liabilities, and this will be nothing but 39 lakhs plus 1.8 times current liability. If I equate these two things, can I say I will be getting the amount of my current liability? Come on, yes or no? Yes, sir. And once I have the current liability available, then we can substitute it and we can get the amount of the current asset, which is 81 lakhs. So this is the approach which, my dear students, you all have to follow when we have to calculate the amount of current assets and the current ratio which is given to you. Okay. So with this, my dear students, I end my May 24 question number 1A, which was for 5 marks, but a very interesting question, because here we had to understand the difference between your operating ratio and your operating expense ratio. So is there a difference between the two? Absolutely yes. So operating ratio dealt with total of COGS plus operating expenses, and once we have sales and we can subtract EBIT, we'll be getting the total operating expense, on the basis of which we have to do the bifurcation. Okay, so this was 1A. Now let us start with your question number 1B. 1B is also an ICAI. This is a leverage question, 5 marks, a very easy and manageable question to solve. So what is given to you? Let us first read the question. Alpha Limited has provided the following information. Equity share capital is 25,000 shares of rupees 100 each. 15% debentures, where there is 10,000 debentures of rupees 750 per debenture. We have sales, which is 50 lakh units at rupees 20 per unit. Variable cost is rupees 12.5 per unit. And then we have fixed cost, which is 175 lakhs. Due to the recent policy changes and entry of foreign competitors in the sector, Alpha expects the sales may decline by 15 to or 20%. However, the selling price and the other cost will remain the same. Corporate tax will continue at 20%, and you are required to calculate the decrease in earning per share, degree of operating leverage and financial leverage separately if the sales are declined by 15% and 20%. First, my dear students, you have to understand what is the question asking. The question is asking, sir, we need decrease in earning per share, OL and FL. And we have to calculate that separately. What is the meaning of this, my dear students? Can I put it like this? Existing, we already have sales, which is 50 lakhs into 20 rupees per unit. So if you just check the solution, existing, we have 50 lakh into 20 rupees. And then we also have variable cost 12.5 or contribution 7.5. So this is the amount of the contribution which you are earning. But my dear students, what is happening? Is my sales reducing by how much? By 15%. So if my sales is reducing by 15%, I hope you guys are trying to understand that now this 50 lakhs will be reduced by 15%. So it will become 42 lakh 50. So based on that, this is going to be the contribution. Similarly, my dear students, it is going to be reduced by 20%. So this is going to be my contribution. So from sales, we have to first reduce all these things, prepare the entire income statement, and then calculate what is going to be the decrease in EPS, what is going to be the operating leverage, and what is going to be the financial leverage. So as you all know, what is the format of the income statement? Do we have the NPAT available? Come on, yes or no? Yes, sir. From contribution, fixed cost, EBIT, debenture interest. A very manageable question till now. And then we have to divide that by number of equity shares. We'll be getting the earning per share, which is 604. Then at 42 lakh 50,000, this is coming as 424. And then at 40 lakhs, it is coming as 364. So what is the decrease in EPS in terms of percentage? Can I say 604 has now become how much? 424. So then we have to take the difference amount, okay, and divide that by 604 into 100. We'll be getting this as 29.8%. Similarly, from 604, if I subtract 364, I'll be getting the difference amount. Divide that by the original EPS of 604 into 100, and based on that, we'll be getting the final answer. Same happens with operating leverage also. So we have to calculate operating leverage by taking contribution upon EBIT. And for FL, we'll be taking EBIT upon EBT. So normal process, we have to follow it for the purpose of calculation. And then we have to see that what is the decrease which is happening in your operating leverage also, in your EPS also, and on your financial leverage also. Okay. And my dear students, based on this, if you want to also calculate your financial leverage, we can do it in other way also, that is percentage change in EPS upon percentage change in EBIT. Okay. But I would prefer that you should do it normally only, as we are doing it in a normal situation by your static formulas, which is EBIT upon EBT, and do that accordingly. Okay. With this, my dear students, now your question number 1B, which was very manageable. We just had to calculate what was your EPS, OL, and FL. We had to prepare the 3 income statements, and we had to calculate that accordingly when your sales reduced by 15% and 20%. And they have mentioned separately. So that's why 3 separate income statement needs to be prepared. Okay. Now let us come to your question number 1C. Now this particular question, this is on your receivables management. It is factoring question. Very, very, very interesting question. Now in this particular question, what is new is that they have given to you cost of capital of the company is 12.5%. Now, ideally, in your factoring questions, as you all are aware, cost of capital was ideally not given to you. Actually, what was given to you in your factoring questions was what was your sales, whatever was your factoring commission, whatever was your CID, cost of whatever was your, from your bank's perspective, if they are going to offer you with some loan, so whatever is the interest cost, that used to be specified, reserves, etc. And all those things were taken into consideration. Now, in this particular question, my dear students, they have given you cost of capital also. So we'll be having your CID percentage also, and we have to do that accordingly. Now see what is given to you, that from the following information, we are required to calculate what is going to be your sales, which is 7 crore 50 lakhs. Out of this, my dear students, your 90% is given to you on credit basis. So the first thing is, whenever you see a question on factoring, we have to first write down what is your credit sales. So 7 crore 50 lakhs, if I multiply that by 90%, so we are having credit sales, which is 6 crore 75 lakhs. Okay. So we are having a credit sales, which is 6 crore 75 lakhs. We have credit period, which is 45 days. Average collection period is 70 days. Now my money is actually getting blocked for 70 days. Though I am offering 45 days credit, but my money is getting blocked for how many number of days? 70 days. Bad debts is 0.75%. And credit administration cost. This is nothing but the collection charges, which we are paying as a company to our own department. And that is 18,60,000, and out of which 2/5 is avoidable. So my dear students, if I take 18,60,000, multiply that by 2, divide that by 5. So I'll be getting 7,44,000. Okay. So is this 7,44,000 avoidable? Come on, yes or no? Then the answer is absolutely yes. So if I'll be appointing a factor, then will this 7,44,000 be saved? Come on, yes or no? Yes, sir. Okay. So if suppose I'm having, with factoring analysis, then you have to understand that this 7,44,000 will not be applicable to you. But if I don't have a factor, then I have to definitely pay this 7,44,000. So this is avoidable. Rest all, is unavoidable. That is, it is irrelevant. We have to take that into consideration, whether there is factor or whether there is no factor. Okay. Now, a factoring firm has offered, to manage the company's debtors on a non-recourse basis. Whenever you use the word non-recourse, it means what? That bad debts will be borne by the factor at a service charge of 2%, which is called as factoring commission. And factor agrees to grant advance at an interest rate of 14% after withholding 20% reserves. So always remember that we are going to take into consideration, whatever is this 20% reserves, that much will be subtracted. And my dear students, when that 20% will be subtracted, the loan will always be provided by taking debtors minus reserves, etc., etc. Okay. And then the cost of capital. Okay. By the way, they have told you that the factor has guaranteed that they are going to make the payment in 45 days. So this 45 days will actually be helpful for you if you want to calculate what is going to be your cost of investment in debtors. So for that, this 45 days will be applicable to you. And then one time redundancy payment of 50,000 is required to be made to the factor. So if suppose I'm having a factor, then do I have to make the payment to that particular factor also? Come on, yes or no? Yes. And how much amount needs to be paid there? So 50,000 needs to be paid. We are required to calculate what is the effective cost of factoring, assuming 360 days in a year. Okay. Now, how do you approach such kind of a question? So first of all, see, I've done some calculations here. If we don't have a factor, so that is called as in-house services without factoring. And if we appoint a factor, okay, so what are going to be the different types of cost which is going to be applicable? The first one is, my dear students, bad debts. Okay. Can I put it like this, that if I don't appoint a factor, then I have to bear the bad debts? Come on, yes or no? Yes, sir. It is my responsibility. But the moment I appoint a factor, then can I say bad debts is the responsibility of the factor, so I don't have to take that into consideration. So what is going to be the bad debts? So they have given to you the percentage. We simply have to take into consideration whatever is your bad debts, which is 0.75%, not of 7 crore 50 lakhs, of 6 crore 75 lakhs, because we have to take into consideration your credit sales. So based on that, can I say I will be getting the amount of the bad debts? Come on, yes or no? Yes, sir. The second thing is collection charges. Now, if I don't appoint the factor, can I put it like this, that if I'm not appointing the factor, then definitely I have to take into consideration, my 7,44,000 as the staff salary is going to do the collection on my behalf. So 7,44,000 is my collection charges. Okay. Then, my dear students, how do you calculate your cost of investment in debtors? So as you all are aware that out of 7.5 crores, 90% is going to be your credit sales. Okay. So 90% is your credit sales. Multiply that by what is the time period in which your money is getting blocked. So that is 70 days divided by 360. And what's your cost of capital? 12.5%. So based on this, I'll be getting my cost of investment in debtors, which is 16,40,625. And if I appoint the factor, then they are giving me the payment in 45 days. So that is an advantage for me. So in that particular case, I will take 7.5 crores into 90% into 45 divided by 360 into 12.5%. So that will give me 10,54,687. Okay. So am I saving something in my CID also? Come on, yes or no? Yes. Now let's talk about interest. So in case of interest, if I'm appointing the factor is definitely giving me some kind of an advance. Now, how do you calculate that advance? So factor always gives advance by taking debtors as a security. So how do you calculate your debtors? So to calculate your debtors, you will take your credit sales. What was the amount of the credit sales? 6 crore 75 lakhs. So we will be taking the credit sales, which is 6 crore 75 lakhs, and you will multiply that by what is the credit period? It is 45. Divide that by 360. So will that give me my amount of the debtors? Come on, yes or no? Yes, sir. And once I have the amount of the debtors available, from that I need to subtract whatever is my reserves and whatever is my commission. So here many students make a mistake of taking the entire commission of 13,50,000 to be subtracted from here. Absolutely no. We only and only have to take the commission pertaining to that particular debtors. So what was my amount of the debtors? 84,37,500. You need to simply multiply that by 2%. You'll be getting the amount of the commission which we need to subtract. And then from debtors, if I subtract my reserves, if I subtract my commission, I'll be getting this as the final answer. And then what is the rate of the interest which they have told you? It is 14%. Ultimately, I'll be getting this as 9,21,375. So is this the amount of the interest which I have to bear? Come on, yes or no? Yes, sir. So this is the amount of the interest, 9,21,375. And there is some one-time payment also which needs to be done, that is 50,000 rupees. So my dear students, without factoring and with factoring, just identify what are the types of the cost which we have to take into consideration, and then take the total cost, and from that total cost, whatever is the difference here, as you all can see that factor is more expensive. So in that particular case, 4,85,187 is something more which we are paying if we appoint the factor. And they have also asked you what is the effective cost of factoring. So how do you calculate the effective cost of factoring? So effective cost of factoring is nothing but 4,85,187. I need to divide that by the amount of advance. So whatever is the loan या advance, I have to divide that and multiply that by 100. Now there are two views which are applicable here. You can consider the advance after subtracting the interest also, or else you can consider the advance before subtracting the amount of the interest. So here, what is the amount of the advance which is coming as? I will take 65,81,250. So if you multiply this and finally get the percentage, that will be called as your effective cost of factoring. Okay, my dear students. So here in question number 1C, they had asked you whether we should appoint the factor or not. And it was a very basic question. Here, the only thing which needs your attention is that they have told you that the cost of capital of the company is 12.5%. In study module, in factoring questions, cost of capital is actually not given to you. But here they have given to you cost of capital, and here it makes sense also because there are two number of days which are given to you. For existing, it is 70 days, and for your factoring proposal, it is 45 days. So that is why we can calculate your debtors and then do that accordingly. Okay. So this was your 1C. Now let's continue this further, my dear students, and come to the next question. And your next question which we want to solve is your question number 2A. Okay. So this is also a very massive question, and very frequently you will see cost of capital in every attempt. So we will understand all the important transaction and adjustment what needs to be done. Now the capital structure of Shrine is given to you, and in which we have your equity share capital, which is 45 lakhs. Okay. We have preference share capital of 36 lakhs. We have retained earnings. Then we have 13% convertible debentures, and then we have term loans, and the total amount is given to you. Now see what is given to you, that the company issued 13% convertible debentures of rupees 100 each on 1st of April 2023 with a maturity of 6 years. Whenever you see convertible, always remember that towards the end of the 6th year, you are not going to get your redemption value, but are you going to get your convertible value? Come on, yes or no? Yes, sir. Now, how do you calculate your convertible value? So to calculate your convertible value, what we need is whatever is going to be the market price per share at the end of 6th year. Now, this is something which is absolutely going to make sense. We should know the market price of an equity share at the end of 6th year. And then once we have the market price of equity share at the end of 6th year, we need to check what is the ratio of the conversion. For every one bond, how many number of equity shares are going to be converted? So if you proceed with this further, the debenture holders will have an option to convert the debentures into equity share in the ratio of 1:4. So my dear students, can I put it like this? For every one bond, 4 shares will be taken into consideration. So whatever is the market price at the end of the 6th year, we simply have to multiply that by 4 to get the conversion value. The market price of the equity share is rupees 25 as on 31st March 24, and the growth rate is 6%. Wow. Now, my dear students, 25 rupees is the market price, right? At the end of which year? At the end of 31st of March 2024. Okay. Now, my dear students, we need for the period of 6 years. So here you have to be very, very, very attentive for you to understand that what should be the market price at the end of the 6th year. Okay. So pay careful attention here in the solution to this particular answer, as you all can just check that here to calculate the conversion value, we know that here 25 rupees is at the end of the first year. Now, when 25 rupees is at the end of the first year and your debentures are going to be converted at the end of the 6th year. So, my dear students, this is 1, 2, 3, 4, and 5. And we have the price which is at the end of the first year. If you read the question very carefully, what have they told you? That this is the market price of equity share is 25 as on 31st March 24. And where are we standing right now? On 1st April 2023. So be very, very, very careful with the wordings of the question, that this is 24. So that's why this is going to be rupees 25, which will be coming as on 31st of March 24. To this will be adding the growth rate. How many number of times? So your 6% will be added 1, 2, 3, 4, and 5 times to get what is the price at the end of the 6th year. Usually, ICAI gives you the market price of the equity share today itself. But for the first time, they have told you that the market price of equity share is at the end of year 1. So that's why we have to take 25 and add the growth rate to calculate price at the end of the 6th year. Okay. And once we get this, for that, we are going to get 4 shares. So this is 133.82. So this was the tricky point in the question where we can find out what should be the market price conversion value at the end of the 4th year. And then if you continue this further, they have told you that preference shares are redeemable after 8 years. It's currently selling at 150. So that's the net proceeds of the particular company. And the prevailing default risk-free interest rate for a 10-year government of India bond is 6%. And the market risk premium, guys, whenever they use the word market risk premium, it is always RM minus RF, which you have to focus on, is 8%, and the beta of the company is 1.54. And then they have told you corporate tax is 25%, and the personal income tax rate is given to you as 20%. Now, what is personal income tax rate and where it is going to be applicable? So always remember that whenever personal income tax rate is given to you, in that particular case, your KE is not equal to your KR. Why is that? Because while calculating your cost of retained earnings, we have to take KE and convert that post-tax by taking 1 minus shareholders' personal tax rate. Now, why is this important? Because if I am the company and you are an equity shareholder, and if I am distributing the reserves to you by the way of dividends, then you will invest it somewhere else subject to tax rate. So that is why while calculating the opportunity cost, we always have to take KR is equal to KE into 1 minus shareholders' personal tax rate. So that's a very, very, very important thing which you have to understand. Okay. Now, based on this, you are required to calculate cost of equity share capital. Now, this is by CAPM approach. We have everything else available, so we can calculate your KE. Cost of preference shares. Here, we can calculate that by taking whatever is the preference shares, PD plus RV minus NP upon N, and we are going to divide that. So, which formula will be applicable here? So, as you all know that they are redeemable preference shares. So, we will take KP is equal to what? Preference dividend plus what we will take into consideration? Redemption value minus net proceeds upon N. And we are going to divide that with what? Redemption value plus net proceeds upon 2 into 100. Based on that, we can then calculate what is going to be your cost of preference shares. Okay. And always remember that when they give it to you that selling at rupees 150, so what is your net proceeds? Your net proceeds is always 150. So whenever they are giving you the selling price per unit or issue price, then will we treat this as your net proceeds? Come on, yes or no? Yes, sir, and do it accordingly. Okay. And then, my dear students, they have also asked you to calculate cost of convertible debentures. So to calculate the cost of convertible debentures, as you all know, how are we going to do it? So KD will be your interest into 1 minus tax plus what will you take into consideration, beta? Conversion value minus net proceeds upon N, the whole upon conversion value plus net proceeds upon 2 into 100. Now for your conversion value, as I've just now discussed, what's your conversion value? 133.82. So is that going to be forming part of your conversion value? Come on, yes or no? Yes, sir. What is your net proceeds? Net proceeds means what is the amount which you're going to receive, or whatever is the market price of the debenture. So they have told you that company issued rupees 100 each with a maturity of this, and they have not given to you any other data available. So can I say that the net proceeds has to be rupees 100 and they have to do that accordingly? Okay. So this is something which you have to understand, that what is going to be your net proceeds, then your net proceeds will be 100 pertaining to your convertible debentures. And then we have to calculate net proceeds 100 and then we have to apply this in the formula and get it accordingly. Okay. So this is pertaining to your cost of convertible debenture. And then, my dear students, we have retained earnings. So how do you calculate retained earnings? As I've just now told you, it is nothing but we have to convert that pre-tax to post-tax. So whatever was your KE, we multiply that by 1 minus tax rate. We got your KR, which is 14.66%. But they have also told you that you can assume KE and KR to be the same as well. They've also told you it can be same 18.32% as well. But whenever the shareholders' personal tax is given to you, what we should do is we will take your KE and multiply that by whatever is the shareholders' personal tax that we are going to subtract. Okay. And then, my dear students, we have the last thing, which is term loan. So for your term loan, my dear students, we have 11%, that is pre-tax. We have to convert that into post-tax. So we'll multiply that by 1 minus tax and we are going to do that accordingly. Okay. So this was your very nice question, question number 2A on your cost of capital. Let's start with your question number 2B. And this question is pertaining to your capital structure theories, where we are going to shift from your levered company to unlevered company. Okay. So how are we going to approach this question? Very, very, very interesting, very important. Let's pay attention to this. They have told you that following is the data available in respect of levered and unlevered company having the same business risk. We have the capital employed available, which we can see it's 2 lakhs for both the cases. We have your EBIT, which is 25,000. We have KE, which is 12.5%. We have debt as well as equity, both given to you, but unlevered company, it means there is no debt in the capital structure. And when there is no debt in the capital structure, my dear students, as you all know that your if there is no debt in the capital structure, we call it as an unlevered company and we're going to proceed that accordingly. And then they have told you that an investor is holding 12% shares. Have they given to you percentage stake? Come on, yes or no? Yes, sir. I've explained to you that when the percentage stake is not given to you, we can assume it as 10% and do that accordingly. Calculate the increase in the annual earnings. So we are going to understand now what is going to be the arbitrage profits which we are going to earn if he switches over from his holding from levered to unlevered company. Okay, so this is your MM approach. My dear students, how should you approach the question? First step is we should prepare what should be your EBIT. Now this question, I'll just solve it in much more detail so that you understand it. EBIT minus interest, that gives you EBT as well as dividend. We have levered company, we have unlevered company. Now for levered company, what is the amount of the EBIT which we have? 25,000. So we have the amount of EBIT which is 25,000. That is going to be there in both the cases. And then my dear students, interest. As you all know that debt is 75,000 and you multiply that by the rate of interest, which is 8%. So this turns out to be how much? 6,000. And then my dear students, if I take 25,000 and subtract it by 6,000, what I get is 19,000. That is nothing but your dividends. Interest is not there here. So this has to be 25,000. Okay. Now, do you have the KE available? Yes, sir. What's your KE which is given to you? Your KE is 12.5%. So we have KE which is 12.5% available in both the cases. Can I find out what is the market value of equity? Come on, yes or no, sir? Yes, sir. How do you calculate market value of equity? We can take the dividends and capitalize it by KE to get the market value of the equity, right? So dividends upon KE, will that give you market value of equity? Come on, yes or no? Yes, sir. So 19,000 divided by 12.5%. We are having this as 1,52,000. And here it is 25,000 divided by 12.5%. So this is nothing but 2 lakhs, obviously. And now, my dear students, I will add some debt to it. So what is the debt of the levered company? As you all can just check, 75,000 is the debt for the levered company. And for unlevered company, obviously there is no debt because it's unlevered in nature. Unlevered means what? No leverage. Koi risk nahi hai. There is no risk at all. So 1,52,000 plus 75,000. This will give you 2,27,000. And here it is 2 lakh itself. So what does it mean? Can I say that your levered company is greater than your unlevered company? Come on, yes or no? Then the answer is absolutely yes. So now value of the levered company is greater than the unlevered company. And we should do this only. We should shift from your overvalued company to your undervalued company. And they have also mentioned that here the investor was holding 12% shares in levered company. Levered company means what? Your overvalued company, and we are going to shift it from overvalued to undervalued. So first of all, what we have to do is we are going to sell your stake. So 12% is your stake. So now what is going to be your sales proceeds? So guys, your sales proceeds is now going to be what? Your market value of equity was 1,52,000. So I am going to simply take 1,52,000 and multiply that by how much percent? So as you guys can just check, you have to multiply that by 12% stake you had. So I'll multiply this by 12%. So I'll come to know from 1,52,000, if I multiply it by 12%, so this will be 18,240. So is this the amount which I've got because I've sold the shares of levered company? Yes or no? Yes, sir. But then, my dear students, we also have to take some loan. Now, why we have to take the loan? So that we can maintain the same level of risk. So MM specifies that when you're shifting from levered to unlevered, unlevered does not have any risk in the capital structure, but levered company definitely has some risk. So as an investor, when you're shifting from levered to unlevered, should you take some loan? Come on, yes or no? Yes, sir. We have to take the loan. But in which proportion are we going to take the loan, guys? So are we going to take the loan in the same proportion which was specified here? Come on, yes or no? Yes. So when your equity was 1,25,000, what was the amount of the debt? It was 75,000. Now, my dear students, what is the amount of the equity shares which you have? 18,240. So can I get the amount of the debt? Come on, yes or no? Yes. Which turns out to be how much? This turns out to be total of 10,944. So now, is this the amount of the loan which you have to take? Come on, yes or no? Yes. So the total amount which you have, my dear students, is now 29,184. What should you do with the amount of the profit? Should you party with it? No, sir. Are we going to invest it somewhere else? Yes, sir. Now just recheck how much percentage stake do you have now. So your percentage stake actually in your unlevered company is now going to be what? You are now going to buy the shares of 29,184. What is the market value of equity here? Your market value of the equity is nothing but 2 lakh rupees. Okay. And if I multiply this by 100, I'll be getting this as, how much is it coming as? 14.592%. Okay. So has my percentage stake increased? Come on, yes or no? Of course, yes, my percentage stake has increased. So my percentage stake has increased. Earlier it was how much? 12%. Now it has become 14.54%. And this is only going to give me arbitrage profits. So the first thing which is going to come is what? Whatever is going to be the dividends from unlevered company. So what was the dividends from unlevered company? Just check. Your dividends from unlevered company was nothing but 25,000. and you are having 14.592%. So guys, whatever is your 25,000, you multiply that by 14.592%. So you will be getting 25,000 into 14.592%. So this will be 3648. But because you have taken loan, do you have to pay some interest also? Yes, sir. Interest paid. Can you please tell me how much loan you have taken? 10,944. So what are you going to do? 10,944 multiplied that by what's your rate of interest? Your rate of interest is nothing but 8%. So I'll be multiplying this by 8%. So 10,944 into 8% will eventually give you what? 876. 5.52. So I'll be writing 876. And then, my dear students, from 3648, if I subtract 876, so you'll be getting what? 2772. Okay. And then what is the dividend lost from levered company? Because you have shifted from unlevered to from levered to unlevered. So in that particular case, as you guys can just check, the dividend was 19,000 and I was having how much percent stake? 12% stake. So if I take 19,000 and multiply that by 12%, I will come to know, okay, sir, 19,000 into 12% is 2280. And then eventually, if I just calculate this, will it lead to arbitrage profits of 492 rupees? Come on, yes or no? Yes, sir. Let us check this out. So your arbitrage profits, here it is coming as 405, because here see it is 12,000, 18,240. Have I taken 18,240 here also? Yes, 18,240. What is the amount of the loan? So amount of the loan here, they have taken it as 75,000, 12%, that is 9,000 rupees. Okay. So I actually had the amount of equity, which was 18,240. So we did more specific calculation. 18,240 multiplied that by 75,000, divide that by 1,25,000. So our amount of the loan is slightly coming higher. But if you just continue with the same percentage stake of 12%, you'll be getting this as 9,000, and then you can proceed with the same answer. So you'll be getting approximately. So what we have taken is, we have taken the loan at the same proportion. Whatever was the proportion of your levered company, we have maintained that proportion and we have taken the loan. Alternatively, you can also keep the percentage stake as 12% and do that accordingly. Okay. Here also they have specified that alternatively you can also do it like this. As you all can just check, there is alternative strategy also which is given to you. And then based on that, we can also do that accordingly. Okay. But eventually your arbitrage gain should be this much part. And there is increase in your improvement of earning. Okay. So this was nothing but, you, my dear students, your question number finally 2 is now getting over. Let us now start with question number 3. Okay. So let's do this now. What is given to you in your question number 3? Now this is a question on your investment decision. Let us go through this fast. The important part I've already highlighted in this particular question. Okay. Let us read it. Okay. Now see, my dear students, what is actually given to you in your question number 3A. It is specified that HCP is actually leading manufacturer of railway parts for passenger coaches and freight wagons, and due to the high wastage of material and quality, the general manager of the company is considering the replacement of A with B. Now this is a question on replacement decision. Okay. Now whenever you see there is replacement decision, can I say we can calculate your incremental NPV? Come on, yes or no? Yes, sir. What is your incremental NPV? We can take incremental PV of CI minus incremental PV of CO. So very simple logic. If suppose your old contribution was 1 lakh, new contribution is 1,50,000. So are we going to take that 50,000 and do the calculations accordingly? Yes, sir. Old depreciation was 10,000, new is 15,000. So incremental depreciation of 5,000 will be subtracted. If the incremental NPV is positive, accept the project or reject the project. So whenever you see the word replacement, always remember we are going to take into consideration incremental concept. Okay. Now machine A has a book value of 4,80,000 and the remaining useful life of 6 years. It can be sold now for 1,80,000 and as zero salvage at the end of the 6th year. Now the purchase price of the new machine is 24 lakhs. So as you all are aware that new machine cost is 24 lakhs. From that I am going to subtract my exchange value, which is 1,80,000. Will I get my incremental PV of CO? Come on, yes or no? Yes. So from 24 lakhs, if I'm going to subtract 1,80,000, I'll be getting 22,20,000. This is the PV of CO which you have to take into consideration. Okay, continuing this further, they have told you something like this, that it will require 1,40,000 for installation and 60,000 for subsidy. Oh, so in this particular case, can I say there is 1,60,000 for your installation also? Okay, and also at the same time you guys can just check. There is some testing fees also. Sorry, 1,40,000 was your installation. Testing fees was 60,000. Okay. And if you guys can just check from this, if I add 2 lakhs, I'll be getting 24,20,000. And then, my dear students, I have to also subtract what is going to be my subsidy. So they have told you that the subsidy of 15% of the purchase price of machine B will be received from the government at the end of year 1. So what is the cost of the machine? It is 24 lakhs. So I will take 24 lakhs and multiply that by how much percent? 15%. So that is 3,60,000. But I cannot subtract 3,60,000. Why? Because this subsidy is actually received at the end of year 1. So what am I going to do is, from this 3,60,000, okay, I will multiply that by the PV factor of 0.877. And once I multiply this by 0.877, I'll be getting 3,15,720. So ultimately, what is going to be my PV of CO? From 24,20,000, if I subtract 315,720, so this will eventually give me what? 21,04,280. Okay. So this, my dear students, is going to be your, finally, what is going to be the answer for this? If you guys can just check here, your cash outflow is going to be what? If you guys can just check, you are going to have your cash outflow as here, if I take it at the end of year 1. Okay. Yeah. So this is what I was talking about. Perfect. So here, if you guys can just check 21,04,280, which is our answer, 21,04,280. Okay. So basically what we need to do is, we have to consider the present value of the subsidy. We have done such questions in your book where the subsidy was received at the beginning. But if the subsidy is received towards the end of year 1, then definitely we have to subtract the present value of it. Okay. Now the general manager estimates that the annual savings due to installation of the machine B will include reduction of 3 skilled workers with the annual salary of 1,68,000. Very simple part. Are we reducing the outflow? Yes, sir. If you're reducing the outflow, can I say it's one type of your savings, and your savings is nothing but 1,68,000 into 3. So that is 1,68,000 into 3. That will give you your savings, which is going to come. So savings is 1,68,000 into 3. If you read it further, 4,80,000 from reduced wastage of materials. So basically there is some savings in scrap also, which turns out to be 4,80,000. So we are going to have 4,80,000 here as savings. And then they have told you that there is some defectives also, 3 lakh from loss of sales due to execution of the purchase order. So that will also be saved due to computerization. So all these losses, all these leakages will all be saved. So that is going to give you a total savings, from which then, let us continue this further. They have told you that your operation of machine B will require some salary, etc., which is to be paid of 3,90,000. And the annual operation maintenance cost will increase by 1,54,000. So are these all increase in cost which we need to subtract it? Yes or no? Yes. And eventually, from your savings, whatever you subtract the cost, you get your NPBDT, because right now depreciation is not yet subtracted. So this is actually called as your incremental NPBDT. From this, I will subtract incremental depreciation. Now, how do you calculate incremental depreciation? If it would have been WDV, then we follow block of asset method. But if it is SLM, then should we consider new minus old? Will that give you increase in your depreciation? Come on, yes or no? Yes, sir. What is your new machine depreciation? Now, for your new machine depreciation, many students will have a reservation that how do you calculate that? Because there is subsidy also, there is original cost of the machine also. So how do you calculate your new machine depreciation? Okay. So for that, institute has given you the clear-cut working that we have to subtract subsidy while calculating what is going to be the, what is going to be the depreciation for the new machine. So in this particular case, the cost of the machine is 24 lakhs, add installation 1,40,000, add testing 60, subsidy from the government, which is 3,60,000, that is subtract. So now, are we going to subtract subsidy? Come on, yes or no? Yes, sir. See guys, institute in the practice manual also had maintained the same, had such kind of a question in which subsidy was not subtracted, and they had actually calculated depreciation on the original cost. But here, my dear students, subsidy is subtracted. So which view should we follow? Then in this particular case, you can follow any particular view, but just write down one note. I would prefer that you, now in this particular question, they have specified, you subtract the subsidy from the government, which is 3,60,000. Okay. And then whatever is the salvage value at the end of the machine which we have to subtract it because this is SLM method. So SLM is original cost minus salvage, divide that by life. So your original cost will be the combination of these three, which is 24 lakh plus 2 lakhs. So that is 26 lakhs. What's your salvage value? Your salvage value is nothing but 3,60,000, and your life of machine is nothing but 6 years. So based on this, we'll be getting the amount of the depreciation, which is nothing but 19,20,000. So my dear students, which is 3,20,000. So this old one was a book value with the remaining life of 6 years. So based on that, we got this as 80,000. This is 3,20,000. So incremental depreciation is 2,40,000. And then we have to subtract this incremental depreciation 2,40,000. We'll be getting incremental NPBT, subtract tax, NPAT, add depreciation cash flows. And are these cash flows going to be constant? Yes. Salvage of the new machine should also be taken. But here also we have to take incremental salvage. Huh? What is incremental salvage, guys? Incremental salvage means new salvage minus old salvage. In this particular case, my dear students, we are simply going to take whatever is your new salvage, which is 3,20,000, because old salvage is not there. We can discount it and we can get it into present value term. Okay. So this is how we calculate the NPV. So this is, my dear students, a very lengthy question which we have just now solved, which is question number 3A, investment decision on your replacement decision making. Okay. Now, what is your net present value PV of CI minus PV of CU? Profitability index, we are going to divide it and also calculate discounted payback period. So how do you calculate discounted payback period? So for discounted payback period, we take present value of cash inflows, and then present value of cash inflows, we will check in how many years we are recovering the same, and between those 2 years will be treated as your discounted payback period, and you can do that accordingly. Okay. Now let us come to the B part. Your 3B is Vista Limited's retained earning per share for the year ended 31st March 2023 being 40% is 3.6 per share. Okay. So my dear students, I have my retained earning available. What is my retained earning available? 3.6, that is 40%. So based on this, can I get my earning per share? Yes, sir. So I can get earning per share, and then once I get the earning per share, I can also get the dividend per share. Okay. So that is something which is specified. If I have retention, I can definitely calculate EPS. Company is foreseeing a growth rate of 10% per annum for the next 2 years. And after that, the growth rate is expected to stabilize at 8%. Is this the question on your two-stage growth model? Come on, yes or no? Yes, sir. Now, what is this two-stage growth model? So in your two-stage growth model, ideally, what are you going to do is, we will check from which year onwards the growth rate is constant. The year from which the growth rate is going to be constant, can I say at that point of time, we can use Gordon's model? Come on, yes or no? Yes, sir. So how do you calculate that? So your P2 will become D3 upon KE minus G. Okay, on this basis, we are going to calculate price at the end of the 3rd year. So my dear students, as you all can check, we are going to prepare a table in which there is year 1, 2, 2. We have dividend per share, market price. We are going to discount it. We'll be getting the present value. Okay. So what was the last dividend which was given to you in the question? So that is based on the calculation you will come to know. Then we'll be adding the growth rate of 10% and then doing it accordingly. So 5.4 was your dividend. You add the growth rate of 10%, we'll be getting D1. Again, add the growth rate of 10%, we'll be getting D2. Then we calculate this P2 and then everything discounted and bring it to the present value terms. So this is how we calculate intrinsic value per share. Okay. So this was your solution to question number 3. Now, my dear students, as you all know, that question number 4 is always your theory question. Okay. Now, in this theory question, see what is given to you, that state with reasons whether the following statements are true or false. That is maximizing the MPS as the financial objective, which maximizes the wealth of the equity shareholder. So what is the answer for this? Definitely true. Because if you maximize the market price per share, there is capital appreciation, wealth of equity shareholder also increases. Combination of lower risk and higher return is known as a risk return trade-off. At this level, risk return profit is maximum. Then the answer is no. Why? Because there's a direct relationship between risk and profit. Higher the risk, higher the return. Okay, so there cannot be a combination of lower risk and higher return, risk return trade-off. So your profit is maximum. That is not correct. Okay, so here we have to take into consideration that there is a direct relationship between risk and return. Higher the risk, higher the profits. Okay. Third, true or false is financial distress is a position when the accounting profits of a firm are sufficient to meet its long-term objective. False. Should we focus on accounting profits or should we focus on cash inflows? Cash inflows. Always remember that cash inflows plays a very important role as compared to the accounting profits. And as you all know, the difference between cash flows and the accounting profits is nothing but depreciation. So depreciation plays a very, very, very important role. So that's why this statement is also false. Angel investors is the one who provides funds for the startup in the exchange of ownership. True, because they are the first investors to the company. Okay. Then what are the forms of bank credit, cash credit, bank OD, bill discounting, bill acceptance, line of credit, letter of credit, bank guarantee, short-term loans. Now you don't have to remember all these things, clean overdraft, advances, etc. Advance against document. So basically all these things I've already explained to you in a theory video. You can find this in the same playlist. There is a theory video in which I've explained all these particular concepts. But just to give you a gist that what are the forms of bank credit, how can you get the loan? So see, this is very common sense that we can go to the bank and ask for short-term loan, long-term loan, cash credit, temporary overdraft, bank overdraft, bill discounting, bills acceptance. So all these things are nothing but the way of financing yourself. So that deals with your question number 4B. Now in your 4C, what have they told you? Discuss the relevant of payback reciprocal in the capital budgeting decisions. Now what is payback reciprocal? Now as you all know that cash inflow per annum, if I multiply that by PVAF, what I actually get is PV of CI, right? Similarly, what is payback period? It is cash, whatever is your cash outflow. If I divide that by cash inflow per annum, what I actually get is my payback period. Now it's a very simple concept. If I tell you that my IRR is 15%, so can I say cash inflow per annum and IRR at 15%? So will I get the PV of CI? Come on, yes or no? Yes, sir. And then my dear students, PV of CI is equal to PV of CI. If I divide that by cash inflow per annum, what I ideally get is something which is called as your payback period. Okay, so this is called as your payback period. So this is important that whatever is your PVAF, that and payback period will be the same when the cash inflows per annum are constant. So we can use that for the purpose of determining what is your IRR. Okay. With this, my dear students, I can say that crowdfunding, that is also a very easy part of theory. Okay. It means, as you all know that, you know, all this for a social cause, there is too much of crowdfunding which is happening. You can see many ads on Instagram, Facebook, etc., where they will be having, you know, this kind of ad where they will portray something and they will tell that everyone can contribute. We want to reach a maximum target of 1 crore. So this is something which is the bank account given how much you all can contribute. So you don't know your investors in that particular case. So that is called as crowdfunding. Okay. Now with this, my dear students, I would like to tell you that your May 24 question paper is now completed. Okay, let us now quickly start with the next question paper. Okay, so let's get started now. And guys, if you're liking this video and if you're enjoying, if you're understanding all the concepts, and if you also want a detailed video on your MCQs also for all this paper, so please in the comment box, I just want to see MCQs. If you want MCQs, then my dear students, I will also make a video on MCQs as well. Okay, of all the past attempt papers. Okay, this we are discussing all the questions and the theory part. If you want a separate video on case studies and MCQs, then do let me know. So I'll make a video for that as well. Now, after this, let us now start with the next paper. After May 24, the next paper which we have is your September 24. Okay, so let's do your September 24. Okay, now September 24, let's get started with this. Okay, I'll just close my May 24 now. And we are now going to start with your September 24. We'll be doing all the important transactions here. September 24. Okay. And in your September 24, let us continue this further. September 24 is here. Okay. Fine. Let's get started now. So September 24, now we are going to have your question number 1. Okay, this was also a very good question. Okay, your question number 1A. Okay, now see, always understand that question number 1A, now you will see that there is little bit of some tricky part involved in it. So I would request you that when you are solving this particular paper now, it is important that you start with, you know, something which is, you know, you take into consideration your questions which you know the best. You can start with question number 2, 3, etc. Because sometimes, you know, there's little bit of tricky part which is involved here. Okay, now see what is given to you, question number 1A. See, by seeing this leverage question, you'll jump into it. You'll feel like, wow, this is such an easy question. Okay, but it is also very much important for you to check what are the technicalities of the question, any figures are missing or not. And then always start with something which you know the best. Okay, and do it accordingly. See, question number 1A. What is given to you? Financial information for the year 23-24 of two companies N and C are given to you. N and C, we have equity share capital, we have debt which is given to you, fixed cost, combined leverage, financial leverage. Obviously, I can find out what is my operating leverage. So what is my operating leverage? Your CL upon FL, so that is 4 in the first case, and 4.5 divided by 1.5, that is 3 in the second case. Very easily done. Now you are required to calculate contribution for N and C Limited. Okay. So when it comes to your contribution, what's the format? You take sales less variable cost, you get contribution less fixed cost. You get EBIT, from which you subtract your interest, you get your EBT. There is no tax which is given to you. But you definitely have your debt. So we will be getting your interest, which is 50,000. We have the fixed cost, which is available as 3 lakhs. Now, my dear students, you also have the OL available. So can I say we can take OL, that is contribution upon EBIT. And what can you do here is we can expand this EBIT by taking contribution minus fixed cost. So this OL available is 4. We don't have the amount of contribution, but we definitely have the amount of fixed cost. We can get the contribution for NNC. So that should be your approach. Second, we are also required to calculate what is the margin of safety which is required to be done. Now, my dear students, when we are dealing with margin of safety, MOS, can I say 1 divided by operating leverage can give you MOS? Come on, yes or no? Yes, sir. So 1 divided by whatever is your operating leverage, which we got it as 4. So your 0.25 or 25% will be treated as your margin of safety sales. Okay. So simultaneously, let us just also refer to the solution for this. You will come to know that contribution will come in exactly in the same way which I have told you. And then also at the same time, MOS you can take as 1 upon operating leverage, that comes out to be 25%. Okay. Then continuing this further. Now this part was very tricky. What is the sales of C Limited? Now Institute by mistake forgot to give you details beyond your contribution. So there was no other details which were given to you. So actually what happened, that in this particular question now, you only had the details up to your contribution, but then we did not have sales, we did not have variable cost. So Institute told that we can assume any PV ratio. It can be 40%, 60%, 50%, anything. So Institute has mentioned here also that we can, they have taken, let us assume that the PV ratio is 40%. Such a bad state. Actually, they should have given, because students must have spent so much of time here just to check that what is going to be your PV ratio, where the sales is given to you, etc. At the end of the solution, they just tell us that let us assume PV ratio is 40%. So then we can assume any other thing as well. That's what they have mentioned, that the solution can be solved by any alternative assumption as well. So based on that, we can do it. Okay. So this was nothing but your question number 1A. Now let's continue this further by taking question number 1B. Question number 1B, see what is given to you. The following information is available for SK for the year ended 31st March 2024. We have cost of production, cost of goods sold. We have average stock of work in progress. And also we have average stock of finished goods, admin selling, receivables collection period, then raw material storage period, creditors. We are required to calculate the working capital requirement by operating cycle method. So what is your operating cycle method? Do we have stock of raw material holding period? Yes, sir. Then do we have WIP conversion period? Yes. We have finished goods holding period? Yes. We have debtors collection period? Yes. And then from this total, what do we subtract? Creditors payment period. What do you ultimately get is called as operating cycle duration. Okay. Now, how do you calculate your raw material holding period? Guys, do you have in this particular case already given to you, which is 65 days? Yes, sir. We are very lucky with this. We have creditors, which is 63 given to you. Yes, we are lucky with this also. We have your debtors collection period, which is coming as how much? 36 days. Okay, great. So we just have to calculate this and this. How do you do that? So we take into consideration WIP conversion period by taking whatever is the average stock of your WIP. We divide that by COP and multiply that by 360. Okay. Now, do I have my average stock available? Yes or no? Yes, that is 94,600. So simply take 94,600. What is the COP which we have? 15,48,000 and multiply that by whatever it is, 360. We will take it into consideration. So then we'll be getting what is the WIP conversion period. So that's how we are going to solve it. And for the COGS, we'll be using the same process, but your average stock of finished goods will be divided by COGS. So here for finished goods, we have to take into consideration COGS. So here this is 22 days. Here there is 60 days. So based on that, my dear students, we'll be getting 22, 60. We take the total, we subtract creditors payment, we get the operating cycle duration. Now, once, my dear students, operating cycle duration, we have got it. So we know that for how much time period the money is going to be blocked. How do you find out the amount of working capital? For that, we need to take into consideration whatever is your, total amount which is invested. So we have COGS available as 14,61,000. So to this COGS, if I add my administrative expenses, I will come to know what is going to be my total cost. So if you guys can just check, we have this as 14,61,000. And to this, if I add 4,14,000, so I will come to know finally 18,75,000. This is nothing but my total operating cost. Now, whatever is your OCD and whatever is your total operating cost, once we have that available, can we calculate the amount of the working capital required? Come on, yes or no? Yes, sir. So my working capital required is 18,75,000. Divide that by what is the number of operating cycles, or you can multiply that by OCD divided by 360. You will be getting the final working capital. So this is by your operating cycle duration. Okay. Now, question number 1C. Now, 1C is again your preparation of your ratios with the help of the data which is given to you. So we have inventory turnover ratio, which is also known as stock turnover ratio. Total asset turnover ratio is given to you. Then we also have your long-term debt to your shareholders' funds. And then we have debtors collection period, we have gross profit ratio, and then we have current ratio, which is given to you. Now, balance sheet as on 31st March 24, we have equity share capital, reserves, long-term loan, it's a question mark. Then we have creditors, fixed assets, inventory, debtors, and cash. My dear students, they have told you that you are required to complete the balance sheet of MNP as on 31st of March, assume 360 days, and all sales are on credit basis. Okay. Now, how are we going to do this? The first step is, my dear students, always remember that when we have at least one figure available. Now, in this particular case, you guys can just check, do we have the amount of equity share capital and reserves? Yes or no? Yes, sir. What is equity share capital and reserves together called as? This is nothing but your shareholder funds. And my dear students, here we have long-term debt to shareholders funds. So now, my dear students, if I have shareholders funds, which is 9 lakh rupees, and your long-term debt is 0.6:1, can I say on the basis of this, we can definitely find out what is going to be the amount of long-term debt? Come on, yes or no? Yes, sir. And once we get the total of the long-term debt, the total of this will be your liability, this will be your assets, and then we have to proceed further. So how will you do that? So in this particular case, once we have the total assets available, can you just check there is one ratio which is given to you as total asset turnover ratio. So this is your second step. We can use your total asset turnover ratio because we have the total assets available. And then we also have the turnover ratio available. It's sales upon total assets. So based on this, my dear students, we'll be getting what is the amount of the total assets. And once we have the total assets which is available, then my dear students, what we need to do is we will be having the total assets available. Then we have fixed assets, inventory, debtors, and stock. So for inventory, it is based on cost of goods sold. So from your sales, you subtract the GP ratio, you will be getting the COGS and use that COGS to calculate your stock. Also, at the same time, debtors collection period, we can take your sales and then do that accordingly with the help of the credit sales. And then we also have, once we have inventory debtors, then once you have your current assets total available, your balancing figure will be your cash. Okay, so this is something which is very much approachable. But which ratio to start with? So we should start with your long-term debt to shareholders funds and then proceed accordingly. Okay. Then, my dear students, let's continue this further. So we'll be now discussing your question number 2. Okay. So let's start with your question number 2. Let's see what is given to you in your question number 2. Capital structure of T Limited as on 1st of April 2024 is given to you, in which there is equity share capital of rupees 10 each, 50 lakhs. We have 10% debentures, which is 40 lakhs. And then we have 12% preference shares, which is given to you. Additional information, the risk-free rate of return is 10%. The beta is 1.75 and the return on market portfolio is 12. The equity share of a current market price of rupees 70. Is this data sufficient for you to calculate what is going to be your KE? Come on, yes or no? Yes, sir. So we can take RM minus RF into beta. Based on that, we can calculate your KE. The debentures are then trading at a price of rupees 80 and the debentures are to be redeemed after 5 years. Okay. But they have not given to you any redemption value. And whenever no redemption value is given to you, can I say we can assume that the redemption is actually done at your par. Okay. Preference shares, then they have told you they are also redeemable after 5 years at a premium of 5%. Presently, they are selling at rupees 104 per preference shares. This is also redeemable formula. So we are going to take into consideration your redemption, but always remember what should be your net proceeds. So can I say market price can be treated as your net proceeds? Come on, yes or no? Yes, sir. This 80, this 104, all this will be taken into consideration as your net proceeds. The company pays tax, which is nothing but at the rate of 30%. And the cost of debentures are to be calculated on the basis of YTM approach. Now, whenever there is YTM, you always have to remember that we are going to use the concept of IRR to calculate the same. And here we are also having a range of 10% and 14%. So between this 2%, is your YTM going to be forming part of it? Come on, yes or no? Yes, sir. Between this two particular percentage, your YTM will be forming part. And then we are required to calculate WACC using market value weights. So how will you calculate first your KE? So KE, my dear students, whatever is your RF 10, RM, which is 12 minus RF, multiply that by beta, you will be getting KE. That's not an issue. But when it comes to your debentures, you have to prepare one table in which there will be your, just check what's the life, 5 years. So can I say year 1 to year 5? Are you going to get interest? Yes or no? Yes, sir. But what's the interest? 10%. 10% on 100. Okay, so that is nothing but 10 rupees. But that is pre-tax. So post-tax is going to be what? 7. So this 7 is going to be the interest. And at the end of the 5th year, you are going to redeem this at 100 rupees. Now, we can take the discounting factor at what percentage rate? So we can take the discounting factor first. They have told you to take the discounting factor at your 10% rate. And then we have to take it at 14% rate. Okay. So let us check that at 10% rate, we need to check that what is going to be your discounting factor at 10%. Okay. And then also at the same time, we need to check what is the present value here, whether it is greater than the PV of C or not. So what is the present value of the debenture? 80 rupees. So your one range will be greater than 80. And then once you discount it at another percentage, which is 14%, we have to calculate the present value here also. And actually this should be less than 80. So ideally one should be greater than 80 and one should be less than 80. And once we have this two as your, whatever is going to be your range, then can I say your YTM will form between the two? Come on, yes or no? Yes, sir. So for the purpose of YTM, what we need to do is, will we consider IRR model? Come on, yes or no? Yes, sir. In IRR model, is your PV of CI equal to PV of CO? Yes or no? Yes, sir. What is the price of the debenture? 80 rupees. So your total of present value should also be what? 80. But how do you do that? So first we'll be taking the cash inflows by the way of interest and redemption value. So first you have the interest for the period of 5 years, post-tax 7 rupees. Redemption value is going to be 100. Let us discount it. Then we'll be getting the two present values. One will be greater, one will be the less. Use interpolation, calculate YTM. Okay. So this is how you can do it. Preference shares, they have not mentioned YTM. So we will use the normal formula KP is equal to PD plus RV minus NP and do that accordingly. Always remember net proceeds. Once again, I'm repeating, we have to take into consideration what is the market price until unless they specifically give it. So then, my dear students, as you all can see here 7 rupees as we discussed, 100 rupees. And then we have to create a range. And then for your KD, you can use that by your IRR concept. So it's coming as 12.72%. And for KP, we will use your orthodox approximate formula on the basis of which we get the KP. And then for market value weights, always and always remember, are we going to have all the instruments market prices available? Come on, yes or no? Yes, sir. So equity share capital will be having market price available, preference shares, debentures, etc. Everything. The market prices will be given to you and then we have to take it into accordingly. Okay. Next, after this, let's continue this further. We are having your question number 2B as explain what is angel financing. So angel financing, as we have just now discussed, it is nothing but early stage of financing. And you guys can just check here. They are going to take ownership of the business. So equity financing word is very, very, very important. And at early stage business, startups, etc., in exchange of ownership, equity, all these things will be taken into consideration for your angel financing. Okay, so depending upon how many marks they are asking you, we have to take into consideration your concept of angel financing. Okay. Chalo, so let's continue this further. Now, what's the next thing which we have? 2 is done. Now, let us come to your question number 3. Okay, question number 3. So question number 3, first part is your receivables management. First, let us read what is given to you. That your AB, enterprise deals in hardware materials having the current turnover of 30 lakhs. So do we have the existing sales available? Yes, sir. How much is that? 30 lakh rupees. All sales are on credit and there is an average collection period of 30 days with 0 bad debts. The customers are requesting to increase the credit period. As a result of increase in credit period, sales will also increase. Other information is given to you. Where we have credit policy A and B, we have increase in collection period, we have increase in sales, and then we have bad debts. Selling price is given to you. Then we also have variable cost. Fixed cost is 5 lakhs. Required rate of return on additional investment is 20%. Creditors. Now this statement is very important because this statement will help you to understand that Along with your investment in stock and debtors, there is increase in creditors also. Just read it. Creditors for variable cost are ready to give 15 days extra for the additional cost incurred. Now, when the creditors are giving you 15 days extra, what does it imply? What does it imply? That is there going to be increase in creditors? Come on, yes or no? Yes, sir. Assume 360 days in a year. You are required to analyze the present proposed policy under total approach and recommend the credit policy to be adopted. Okay. Now, my dear students, how are we going to solve this? Okay, question number 3A. Okay, pay careful attention. My dear students, whenever you receive such kind of a question on receivable management now, we have existing policy, we have policy 1, we have policy 2. Okay, from sales, what do you subtract? Variable cost, you get contribution minus fixed cost. What do you subtract? You get your profits. And then from this profits, you subtract your bad debts, whatever is your collection charges, whatever is your cost of investment in debtors. And then we'll be getting the final net benefit. Okay, provided there is no tax which is given to you. And apparently there is no tax here as well. Okay. Now, if you just continue this further now, you will come to know that here my existing sales was how much? It was 30 lakhs. Okay, there is no doubt about it that my existing sales was 30 lakhs. And then this is eventually what? Is this increasing? Yes, sir. So now this is increasing by how much? 3 lakh rupees, and this is by 5 lakhs. So my dear students, this will now be what? 33 lakh rupees, right? And then my dear students, this will be 35 lakh rupees. Okay. So this is the amount of the sales. Now, my dear students, from sales, what do you subtract? You subtract variable cost, you get contribution, you subtract fixed cost, you'll be getting the profits. Now, we are also going to subtract your additional cost. So, do you have any collection charges? No. Do you have any bad debts? Yes, sir. We do have the bad debts. So, we have to subtract the bad debts also 1% and 3.5. That is also. But, my dear students, here in this particular question, is there any increase in your creditors also which is happening? Come on, yes or no? Yes, sir. Now, see how beautifully Institute has presented this. They have told you that your creditors are increasing. And if your creditors are increasing, we have to take into consideration what is your final investment in your working capital. Now, my dear students, as you all can just check, you will come to know, yes, sir, we are having your creditors as, see, variable cost are ready for extra 15 days credit. So as you guys can just check, how much is the variable cost increasing? Earlier it was how much? 15 lakhs. Now it is how much? 16 lakh 50. So the variable cost is increasing by how much? 1,50,000. Is your variable cost increasing by 1,50,000? Yes. And for this 1,50,000, are we getting some extra credit? Yes, sir. We are definitely getting the extra credit. So 16,50,000 into, 1,50,000 into what is the extra credit which you are getting? 15 days. So into 15, we need to divide it by what? 360 days. Have they mentioned here in the question how many number of days we have to take into consideration? Yes, 360. So you divide that by 360, you'll be getting 6250. So is your creditors increasing by 6250? Come on, yes or no? Yes, sir. Your creditors are definitely increasing by 6250. So now what is happening is that while calculation of your increase in investment in working capital, we will definitely take variable cost and fixed cost. So we'll be getting total cost, because debtors we are going to value it on total cost basis. So that is called as total cost approach, right? There is variable cost, there is fixed cost. You add both these things, you will be getting your whatever is 21,50,000. Okay. And then, my dear students, you all can also check that we are having average debtors. So average debtors is what? 2,68,750 based on whatever is the credit period. And your creditors is 6250. Ultimately, we'll be getting average investment in your debtor, in your working capital. On this, we have to multiply that by 20% to finally get what is your CID percentage. Okay. So this is how we are going to solve your question number 3A. But the most important part here was that don't miss out on this. Are we going to increase your working capital? Come on, yes or no? Yes, sir. So there is going to be increase in stock, debtors, and increase in creditors. Of course, there is no stock here. So debtors, your money is getting blocked. And we are going to value the debtors on the basis of total cost basis. Similarly, in your increase in creditors, the money is getting released. So working capital is what? CA minus CL. So debtors minus creditors, that will give you working capital, which we need to multiply by whatever is your CID percentage to get defined. Okay. So this was your question number 3A. Now let's do your question number 3B. Now this is a very easy question on your capital structure for 5 marks. Here we simply have to just check that which plan are we going to select by maximizing the benefit to the equity shareholders. Okay. So they already had some number of equity shares. The market price was 24 and P ratio was 8. The company is planning to purchase the land plant, which will cost how much? Beta 5 lakh rupees. And this is going to give you a EBIT of how much? 2 lakh rupees per annum. And there are two alternatives, A and B. So we can prepare the summary and then do it accordingly. Cost of debt is 12%. So this will help you to calculate the amount of interest. An equity share of face value of 10 each will be issued at a premium of 10 each. So your issue price is 20. So whenever we are issuing new equity, the number of equity shares will be divided with what? It will be divided by 20. And then based on that, new equity shares will come. We already have old equity shares. Old plus new put together will give you total number of equity shares, which will actually help you to calculate what is going to be your final, number of equity shares for the purpose of calculation of EPS. P ratio of the leverage company will be nothing but what? It is given to you as 7. So leverage company means what? When we have introduced debt in the capital structure. So in this plan A and plan B, which plan will have a P ratio of 7? Then it is this particular plan which will have a P ratio of 7. So you're existing at a P ratio of 8. It can be converted to 7. But if you're taking more debt, then it will be turned out back to your 8. Okay. And then, my dear students, we are required to calculate. So as I've also taught you in the same way, that the first step is always summary of financial plans. So first step, we always prepare summary of financial plans. Then we start with your EBIT. And then based on that, your EBIT, we're going to subtract old interest and your new interest. So old interest means your debt which was already there earlier. So that's going to be your old interest. For your new interest, we have to take into consideration the plan in which there is debt in the capital structure. And then based on that, we'll be getting the final interest, debentures, here, as you all can just check, here there is no old interest. Okay. This was existing EBIT and the new EBIT. Put together, that gave you total EBIT. Okay. From that, we subtracted the amount of the interest. We got the EBT. From that, we subtracted tax. We got the NPAT. We divided that by the number of equity shares. We got the EPS. And then we multiply that by respective P ratio to get the market price of the share. Okay. We will always select the plan in which the MPS is going to be higher. Okay. Now, let us come to this theory. Question number 4. Discuss any two advantage and disadvantage of raising finance by the issue of debentures. Now, whenever we are raising finance by issue of debentures, what are the advantages? So, of course, cost of debt is much lower and interest is allowed as a tax deduction. Okay, these are the two important points in the first case. And debenture finance does not result in dilution of control. They are not going to be the equity shareholders of the company. So, in that particular case, I'm not worried about the ownership. And in the period of rising prices, debentures is advantageous because where or else in the balance part of the economy, everywhere the interest rates are increasing. But in my case, the interest rates are kept constant because there's a prefixed interest rate attached to it. Okay. Then discuss the disadvantages of the debenture financing. So then there is obligation. So the leverage of the company increases. Protective covenants associated with may issue to be restrictive. So you cannot always issue debentures unless you don't fall under the law. And debentures financing enhances the financial risk control with the firm because of the reason since debentures need to be paid at the time of maturity, there is a large outflow. Because at the time of redemption, we have to give the money back to the debenture holders. So definitely the outflow is going to be higher. Okay. Then what is the second part of the theory question which we have? We have what are the 4 assumptions of Gordon model? Okay. So what are the 4 assumptions of Gordon model, guys? So for Gordon model, there is no debt in the capital structure, right? Also at the same time, IRR will remain constant. KE will remain constant. All these are, KE should always be greater than G. All this we have also written in our notebooks that we have to take into consideration Gordon's model and then do it accordingly. Okay. Then my dear students, we have something which is called as leverage lease and remedies of overcapitalization. So what is leverage lease? So in this particular case, what is happening is the third party is involved besides the lessor and the lessee. Okay. So let's say, for example, if I want to buy a plant and machinery, so there is a lessor and there is a lessee. Okay. Now I can definitely take this particular plant on lease basis from the lessor. Okay. Now the lessor borrows. Now how is the lessor going to finance it? The lessor borrows part of the purchase cost from the third party, that is lender, and the asset to be purchased is held to be against as the security against them. So my dear students, are we going to take some loan? Come on, yes or no? Yes, sir. But that is nothing but how much? 80%. Okay. So that is something which is being financed by the lender. Okay. And the lender is paid off from the lease rental. So every year the EMIs will always be in the form of lease rental. Okay. And then my dear students, they have told you that the lessor is entitled to claim depreciation allowance. So all these are nothing but what leverage lease. What is leverage lease? That in this particular case now, what I will do is I want to give some particular plant and machinery rent basis, but I will just contribute 20%, 80% I'll take the loan. And then you as a customer, when you'll giving me the rentals, out of that some part will go where? It will go to the bank, and the balance part will be the profits for me. Following steps may be adopted for negative consequences of overcapitalization. What is overcapitalization? Now, in this particular case, there are more number of equity shares and market price in the economy, because of which there is overcapitalization. Okay, so to reduce that, what we should do buyback of shares. We should do any claim of the redemption of your debenture holders and creditors, and value shares may also be reduced. So this will result in sufficient funds of the company and to carry out any replacement of your asset. So then we can take this into consideration, that always remember that whenever there is overcapitalization, the first thing you have to understand is we should buy back the shares back, and then we have to reduce the claims of debenture holders and creditors, so that they cannot get converted into equity shares and then once again capitalize it. And then value of the shares can also be reduced when we are doing so much of your the last part, which was nothing but overcapitalization. Okay, so with this, now your September 24 is also completed. Let us continue this further now with the next paper. And your May 24 was done, September 24 was done. Let's do Jan 25. Okay, let's do Jan 25. After this paper, we'll take just a small break, and then we will continue this further. Okay, so I'll just open up the file for your Jan 25. Okay, Jan 20. Okay, are you all ready, guys? Let's start with your question number 1. Okay. Okay. Now, my dear students, we are ready with the question and answers for Jan 25. So let's go for it. Okay. Now, the first question which we have is actually a question which is there on your cash budget. Okay. Let us read this question. Okay, fine. Okay, let's get started now. KP Limited has been provided with the following information. We have estimated monthly sales in which there is April month, May, June, July, August, September. We have gross profit ratio, which is 20%. COGS is paid in the next month. That data is also given to you. And sales are in credit, and credit period is allowed for 2 months. So basically what is happening is that April month sales. Okay, when are we paying that? Your April month sales, when are we paying? As we have just now discussed, that we are paying April month sales in is allowed for 2 months. So we are paying that in June. May, when are we paying? July, right? June, when are we paying? August, and so on. So that is how we are paying it. Indirect expenses are paid in the same month. Okay. Dividend amounting to your September 24, 3 lakhs will be paid in the next month. And cash balance is 1.5 lakhs. The company has to maintain the minimum cash balance of 1 lakh. If there is any deficit, okay, so let's say for example, if the closing balance is coming as 80,000, so we have to maintain a minimum of what? 1 lakh. So the balance 20,000 rupees, what is to be done? Then for that we have to take, some kind of your temporary short-term loan we have to take into consideration. We have to take some kind of overdraft, etc. And if the cash balance exceeds 2 lakhs, then only the company can invest in some short-term investment. So basically, if your closing cash balance is coming as 2 lakh 50, is it greater than 2 lakhs? Come on, yes or no? Yes. By how much amount? 50,000. So what are we going to do with the same? Then in that particular case, we are going to invest it somewhere else. Okay. So this is a very basic question. Here in this particular question, we simply have to take, whatever is your sales, we have to make the payment accordingly. So as I told you, we are preparing it from 1st July onwards. So can I say that May month's payment will be received in the month of July? Okay. So let's start with this collection. As you all can see, this 12 is from the period of May month. Similarly, June month payment will be received in August because it's 2 months, right? So June and so July and August. So that is how 15 will be received when beta. It will be received in the month of August. And then also, my dear students, your whatever is your July month's payment, when that will be received beta, that will be received in September. Okay. So that is how we are going to prepare this 3 collection from debtors, after which we will be having the total cost amount available, and then less payments. So now when it comes to less payments, my dear students, we have to understand that first we have to make the payment of COGS. So what have they specified? They have specified that whatever is your sales minus 20%, that actually gives you your COGS. Sales minus GP, that actually gives you your COGS. So my dear students, do you have the sales available? Come on, yes or no? Yes, sir. What is July month sales? It is 10. What is your GP? 20%. So how much is your COGS? 80. Okay, but when are we making the payment? So COGS is paid in the next month. So can I say this July month's payment will be made in the month of August? So as you all can just check, this is of July month, which is paid in the month of. Okay, same concept applies here, my dear. Okay, indirect cash cost, it's paid as it is. Dividend, when are we paying that? Then on columnar basis, we'll be taking opening plus receipts minus payment. That will give you closing. In the first month of July, you all can just check that your minimum cash balance is how much beta? It is 1 lakh. Okay, it is 1 lakh rupees. But we have to maintain at least how much beta? Can I say you have to maintain at least 70,000? Come on, yes or no, sir? Yes, sir. You have to at least maintain 1 lakh, and here it is 0.3. So the closing balance is 30,000. So it means that should we take 70,000 by the way of your borrowings? Come on, yes or no? Absolutely yes. We have to take this by the way of borrowings. Okay. Similarly, what is going to happen in your next month? In the month of August, as you all can just check that we are having the closing balance of 7. Oh, is 7 greater than your 2? Come on, yes or no? Yes. By how much amount? 5. So we are only allowed to invest 5. So this is 2. And then, my dear students, here it is negative 2.7. Now, this doesn't mean that we have to sell our temporary investments. We don't have to until unless they don't specifically tell us. So it means that, are we going to take some borrowings? Come on, yes or no? Yes, sir. We are going to take the borrowings. And based on that, we are going to take, because that is minus 2.7. And we are taking borrowings of, 3.7. So only then it can become the closing balance of 1. Okay, so based on that, we have to do the calculation. Perfect. So this is how, my dear students, will be doing your question number 1A. Fairly easy question. In this question, we just had to do cash budget. So very much manageable also. Similarly, question number 1B is also very much manageable. In this particular question also, we have the balance sheet of Exim as on 31st of March. And then we have your total of the assets. We have your total of liabilities also. We have fixed cost, variable cost, which is 70%. Total asset turnover ratio is 2.5 times. My dear students, if I have total assets available, and if I also have what is my turnover ratio, can I say with the help of this, I can find out my sales? Come on, yes or no? Yes, sir. Because what's the formula for your total asset turnover ratio? Total asset turnover ratio is nothing but sales upon total assets. So my turnover ratio is 2.5. I don't have the amount of sales, but definitely I have total assets, which is nothing but 80 lakhs. So if I take 80 lakhs and multiply that by 2.5, so I'll be getting the amount of the sales, which is nothing but 2 crores. Right? So I'll be getting this by the way of your sales. And then, my dear students, we have to continue further and then solve it accordingly. So in this particular case, how are we going to do it? So EPS, OL, FL, CL. So once we get the sales, then, my dear students, variable cost will subtracted. We'll be getting contribution. From that, we'll subtract your fixed cost. We'll be getting EBIT. Then subtract the interest element, EBT, tax, which is 30%, and PAT. And then, my dear students, we're going to divide that by number of equity shares to eventually get what is your EPS. Okay. So very easy question. I think it was there in everyone's textbook also. So you can just use that and do it accordingly. Okay. Question number 1C. Now this is regarding a dividend decision. Here it is mentioned Walters model. So as you all know, my dear students, Walters model formula is what? P0 is equal to D plus what? E minus D into what? R upon K, which we're going to capitalize with what? K. Now in this particular case, as you all can just check, you know that we are having profits before tax, from which if we subtract tax, we get NPAT. We divide that by number of equity shares, we will be getting EPS. Then, my dear students, we have return on investment 18%, and we also have KE as 15%. Okay. So can I put it like this, that my KE is 15%. What is my R? My return, which they have told you, that is 18% upon what? 15. And then, my dear students, we can get your dividend per share plus earning minus dividend per share, because we have the dividend payout ratio of 50%. So whatever is your EPS, you multiply that by 50%, you will be getting the payout ratio. We are required to determine the price of equity share as per Walter's model, so we can do that. And to determine the dividend payout ratio if the price of the share is 48. So now we have to go a little bit reverse, because now we have the price available as 48. What should be the payout ratio? So let your earning per share is available to you. Let your dividend per share be X. So that will be X plus whatever is your EPS minus X, and what's your R, return on investment, 18, and divide that with your whatever is your cost of equity, which is nothing but 15, and then we capitalize that by 15% and do that. So on that basis, we'll be getting whatever is your dividend per share. And once we have got your dividend, can I say based on this, we can also calculate your payout ratio? Come on, yes or no? Yes, sir. Which is DPS upon EPS into 100. On that basis, we can calculate the payout ratio. Okay. So this was your question number 1C. Again, very easy to calculate it. Nothing new in this. Question number 2A. Okay. Now what is given to you in question number 2A? Let's read this out in your question number 2A. Okay. Let's get started. Question number 2A. Let's do this. The following information pertaining to CMC is given to you. We have number of equity shares. Then we have book value of 10% convertible debentures, book value of 12% term loan, market price of equity share, market price of convertible debenture, which is 108. So this is having a market price of 108. Face value of equity share is 10, and face value of convertible debenture is 100 rupees. Beta coefficient is 1.5, and rate of return is nothing but what? It is nothing but 4.5% risk-free rate. If you continue this further, we also have equity risk premium, which is given to you. And then we have your rate of taxation. And then the company expects that the share prices will rise in future on an average of how much? 6%. And then the 10% convertible debenture of rupees 100 each will be converted in 6 years time into equity shares of the company in the ratio of 1:4. Okay. And the market value they have told you, which is nothing but 12%. You are required to calculate what is going to be your, CAPM approach. So my dear students, for CAPM approach, as you all are aware that we have to take RF plus RM minus RF into beta. So do we have your RF available? Come on, yes or no, sir? Yes, sir. Now just check the solution for this. We have your RF available. Okay, question number 2A. Where are we here? Okay, RF is available, which is nothing but 4.5. RM minus RF is 9, because they are assuming whatever is the security premium as your market risk premium only. But actually in final CA, you'll come to know that security risk premium is not your market risk premium. Actually, what is your market risk premium is nothing but RM minus RF, and your security risk premium is RM minus RF into beta. So based on that, we have to do the calculation. Okay. Let's continue this further. We are going to use your CAPM RF plus RM minus RF into beta, and based on that, we'll be getting 18%. So ideally, whenever you see risk premium, it has to be 18 minus whatever is your RM minus RF only. That is something which we have to take into consideration. Okay. Now, my dear students, what is the convertible debenture? Okay, cost of convertible debenture. So as we have discussed in the earlier paper also, to calculate convertible debentures, we need conversion value. And what is your conversion value, guys? Whatever is your P0, okay, to that we have to add the growth rate for the number of years. You will come to know that what is going to be your conversion value. Okay. So here, my dear students, the growth rate was given to you as 6%, which was going to be same over the period of 6 years. So based on that, we got the conversion value. And then we have to multiply that by the number of equity shares, which was 4. So this was the total conversion value, the net proceeds we had. We just have to do the calculation and then get it as 19.52%. Now, what is the cost of the bank term loan? So here we have to take interest rate into 1 minus tax. You'll be getting the bank term loan, which is nothing but 8.4%. And then WSEC using market value weight. So for market value weights, always remember that we have to take market price of every instrument, multiply that by number of equity shares. Now you must be wondering, sir, in examination, when they don't give us which weight should we follow? Now it completely depends. If suppose they tell you that, market price of every financial instrument is given to you, then we will use market value weights. Okay. And if they specify that, we have to use market value, then only that particular case will be taken into consideration as your market value weights, and then do it accordingly. Okay. Continuing further, let's proceed further with your, because see, all this is a very easy question. Okay, very easy, very much manageable to do the calculations part. But let us now do your this B part. Okay, see what is given to you. The following information pertaining to your MSD Limited for the year ending 31st March. We have raw material storage period, WIP. We have finished goods storage period. We have debt collection period. We have creditors payment period. The annual operating cost, including your depreciation, is 4,80,000, was 60 lakhs. But my dear students, we never want your working capital, including depreciation. We follow cash cost method. So here from your 60 lakhs, we have to subtract what is your depreciation. So that is 4,80,000. So then in that particular case, from 60 lakhs, if I subtract 4,80,000, what I actually get is 55,20,000. So this is your annual cash operating cost. Now we are required to calculate what is your operating cycle period. So simply take the total of all this particular time periods and subtract that by your creditors payment period. Then we'll be getting what is the OCD. And once we get the operating cycle duration, take your annual cash operating cost, which is 55,20,000, multiply that by whatever is your operating cycle duration and do it. So you'll be coming to know what is the working capital amount. Similarly, what is the number of operating cycles? So how do you calculate your number of operating cycles? So once we have got the operating cycles available, take 360, divide that by your operating cycle duration, will be getting the number of operating cycles. Okay. So here this is coming as 96 days and this is coming as 3.7.5 times. And then what is the annual amount of working capital required? So my dear students, it should always be on cash cost basis. So that is nothing but 14,72,000. So after we subtract it, okay. So that's how we'll be getting the answer. Sure. Now next, after this, let us come to question number 3A. Now this is the question on your investment decisions. So let's do this. See what is given to you in your question number 3A. SRT Limited manufactures steel rods and is now considering purchase of a new aluminium smelting and molding plant. Now you are manufacturing steel rods and basically the plant will have the cost of rupees 20 lakhs to purchase and install the plant. So do we have the PV of CO? Yes, sir. We have the PV of CO, which appears to be how much? 20 lakh rupees. Okay. And then it has a useful life of 5 years with a residual value of how much? 1 lakh. And production and sales from the new plant are expected to be 1 lakh units. And other estimates in which we have selling price per unit, we have direct cost per unit. After which they have specified that fixed cost, including depreciation, is nothing but 8 lakhs. Now, for the first time, it is including depreciation. What does it mean? That from the NPBDT, when I will be subtracting, from your sales less variable cost, I'll be getting contribution from that. If I subtract the fixed cost, what I'm actually going to get is my NPBT. Okay, not NPBDT, because fixed cost is including the amount of your depreciation. So I'll be getting your NPBT, okay, from which then I have to subtract tax and do that accordingly, okay. They have told you that marketing and promotion cost not included in the above will be 1 lakh and 1,60,000 for year 1 and year 2, okay. So basically now we are having different years and we are having different types of what is the marketing and production cost. So basically your cash inflow per annum concept will not work. Compulsory, do we have to prepare a table? Come on, yes or no? Yes, sir. Additionally, there is investment in debtors and stock, which will increase in year 1 by 1,50,000 and 2 lakhs respectively, and creditors will also increase by 1 lakh in year 1. Now your ICAI has given to you two solutions. They are telling you that if you have done it in year 1, we have not specified year 1 end or year 1 in between. So that is something which is not specified. Okay, if it is year 1 end, then can I say that we have to take discounting and bring it to the present value terms? Come on, yes or no? Yes, sir. And my dear students, if it is at the beginning of the year, then there is no need for discount. But basically, we will always use this rule, and that is that whenever there is going to be your, they have mentioned the word year 1, always remember that it should always be at the end of year 1. When it is going to be better, it is always going to be at the end of year 1. So this is something which you don't have to forget. It is always at the end of year 1. Okay. Thus, debtors, stocks, and creditors will be recouped at the end of the 5th year. So it will be recovered at the end of the 5th year. This is something which we already know. The cost of capital is 18% and the corporate tax rate is 30%. And depreciation is your tax deductible and the company follows straight line method. We are required to calculate the NPV and the profitability index. Okay. How do you do that? NPV and profitability index. So for that, my dear students, we have to prepare a table like this. Okay. So basically, what are you treating at the end of year 1? Okay. So see, we have units, then we have selling price per unit. We'll be getting sales less direct cost. From that, depreciation. Now depreciation, we can calculate it because that depreciation is already including in that. So we can calculate it depreciation by using your SLM method. You will come to know what is the amount of the depreciation. You subtract it, you subtract your fixed cost, total cost, profits, you subtract tax and PAT, add the depreciation back again. Okay, then we'll be getting the cash inflows, and we are discounting with this cash inflows. And here also the important part is what? That when are we receiving this money? Today, a recovery of the working capital will always happen at the end. So 2,50,000 will be coming here towards the end. Okay. And also remember that, are we making some investments? Yes, sir. And we are making the investments when, beta? So we are making the investment at the end of year one. So we have to convert that from future value to present value and also do that accordingly. Okay. And then add your residual value. Okay. Net cash flows, you discounted, you'll be getting into present value terms. Okay. So profit, we should definitely purchase it. Okay. So this is what we are going to do it. Now, let's continue this further. So see, if you do it on my method basis, what was my method, beta? That working capital, we always assume that it is to be paid right now only. But if suppose they have given to you year one, then we will assume it at the end of year one. So we have to discount it and we have to bring it to the present. Okay. So that is how we'll be getting the PV of CO, which will be different as compared to your PV of CI. And then accordingly, we have to do the calculation. Okay. 3A. Now let's do your 3B. What is 3B, my dear students? Oh, this is a very easy question. Here, we have to prepare the balance sheet. The equity share capital of Sky is given to you, was 2 lakhs. Then we have current debt to total debt. Now, this is a very, very, very interesting question, on the basis of which you will understand, sir, here, what is the difference between, what is the difference between what is going to be the difference between your short-term debt and your long-term debt. That is something which is very, very, very important. Okay. So current debt to total debt, we are going to have this as 0.35. Total debt to owner's equity. Okay. Now see, when you have current debt to total debt, it means that your total debt has two components. That is current debt and long-term debt. So current debt is always short-term in nature, and long-term debt they have given to you in the particular question. So if you continue this further, what is given to you, that current debt to total debt is 0.35. What is it, guys? It is 0.35. Okay. So current debt to total debt is 0.35. Okay. So first, let us find out total debt. Do we have the equity available? Come on, yes or no? Yes, sir. That is nothing but 2 lakhs. So can I put it like this? Total debt to owner's equity is nothing but 0.65 upon 1. Now, total debt we don't have, but owner's equity we have, that is 2 lakhs, is 0.65 upon 1. So will I get the total debt? Come on, yes or no? Yes, sir. And once I get the total debt, then we have to divide it into current and your long-term debt. So your balance sheet will look something like this, in which there will be equity, there will be your current debt, there will be long-term debt both. Okay, so these two things are very important. So these two things are also going to be there. Okay. And then, my dear students, on the asset side, we'll be having fixed assets. And then we'll be having current assets, in which there is only stock which is given to you. And the balancing part is nothing but other current assets. Okay, so eventually you'll be getting the final answer. So the starting point of the question is what? That we should take into consideration whatever is your share capital, which is 2 lakhs. Okay. So we have to take share capital, which is 2 lakhs. That is the first thing which is required. Okay. And then total debt to owner's equity, that will give you an apparently better answer. Okay. And then, my dear students, we have total debt to owner's equity, fixed assets to owner's equity, that will help you to calculate your fixed assets. And then total asset turnover ratio. So once we have the total of the liability side available, that the same thing which is the total of the asset side, we can use total asset turnover ratio to calculate the amount of sales. And because there is no GP ratio which is given in the question, then we can value the stock at sales and then do it accordingly. Okay. So this is your question number 3B. Okay. Now let's come to the theory part. Explain environmental, social and governance linked bonds. Now basically, see, as the name only suggests, these type of bonds are which type of bonds? When they are actually issued now, they are issued with an objective, they are issued with a purpose of doing betterment for the society, or they are complying with the governance. So for that, these particular bonds are issued. Suppose I am for example a manufacturer of a particular chemical. Now government has told me that this particular chemical, when you're manufacturing it, okay, whatever is the waste etc which is released, you have to have your own plant to treat that waste. Now for that I have to buy the plant, but I don't have the money. then I can issue the bonds specific for that purpose of buying that particular plant. So I'm going to issue the bonds with only one objective, that with the money which I'm going to get, I am going to definitely, make that particular plant and use that particular plant for the purpose of, whatever is going to be your manufacturing of this wastage, etc. Okay. So this is actually called as my, what is going to be a social environmental bond. Okay. So basically, as you just read it, these bonds carry a responsibility of the issuer to prioritize the optimal environmental, etc. So basically, the money which we are going to use it, we are going to use it for that particular purpose only. And there are some examples of it, like green bonds. Okay. So these are going to be for financing green projects. Okay. Environmental friendly projects. So if I want to have my own EV car manufacturing company, so something like that, for that, if I'm issuing a bond, it's called as a green bond. Social bond. So for human rights, animal welfare, etc., you want to, issue the bonds, raise the money and use it for this particular cause. Sustainability linked bonds. Okay. So it's combination of green bonds and social bonds. Okay. It is not for a specific, for a project, but general corporate responsibility. Okay. For a general corporate. So this was A part. B part, what are the objectives of wealth maximization? So as we have discussed, wealth maximization, long-term gains. So recognize the risk or uncertainty, timing of returns, and consider shareholders' return. So just imagine a situation where, if I am a CFO and I am going to only and only make decisions to maximize the wealth of equity share. Now, when I am maximizing the wealth of equity shareholders, okay, Lakshman has asked one doubt, sir, in model test paper question number sent by ICAI for CA. Okay, I will take this request into consideration and I will record a video and give it to you before your September 26 examinations. Don't worry, okay? But just give me a proper link, okay, on what is the which model test paper series, question number 7, subpart what, whatever is your data, just tell me that I can help you out with the video for the same. Okay, then let's continue this further. What is given to you? With wealth maximization, I was saying that, we only focus on wealth maximization. What should be the share price, how that particular share price is going to be increased, and all those things. So that will really be beneficial to everyone. Okay. And then what are the advantages of virtual banking? So virtual banking means what? In net banking, etc. Now in this basis, there is lower cost of handling, immediate response, speed is more, lower cost of operating. First we used to deposit the check, wait for that. So all those things gets over when there is online. Okay. It allows possibility of improved and range services to be made customers rapidly. So we can have a variety of services based on that. Okay. And concept of exclusion of financing cost principle. Okay. Exclusion of financing cost. Can I say interest, etc., which we don't take into consideration in your breakup of cost. So the exclusion of financing cost principle means that the interest on long-term term is ignored while computing profits and taxes. So we don't consider this interest part, and also the expected dividends are deemed irrelevant for the cash flow analysis. Okay. So basically what we take into consideration is that this debentures, etc., interest, we don't take it. We want to check the operating efficiency. So that is why all this financing cost we excluded for the purpose of decision making. Okay. So this was your Jan 25. Okay. Now, my dear students, the next one is going to be your September 25. Okay. But we will just wait, take a small break of 10 minutes, and then we will continue with September 25. Okay. So September 25 is going to be after the break. So right now it's 6:10. I will be exactly starting at 6:20, and then we'll be doing your next part, which is going to be your September 25. Okay. That's it. So take a break of 10 minutes. Okay. Are we all ready? Can you guys hear me properly? Let's get started. Now with the next paper. Thank you, Sakshi Sangvi, for such kind words. Really means a lot to me. And some appreciations from students also keeps me motivated to perform better and keep on giving you such kind of content free on YouTube. Okay. So I really try my best. If you guys like the video or if you guys get some value addition from it, then do share it with your friends. Okay. Comment on the video. Okay. And just share it with the maximum people so that so many of you can get the advantage of this. Okay. So now, my dear students, we were done with Jan 25. Now we are doing your May 25. Your May 25 is not done, right? So let's do your May 25 first and then we'll do September 25. Okay. So let's do your May 25 first. And guys, also at the same time, I would just like to make a special reference to VIVITSU book as well. And as you all can see that in this particular book, you have all the types of questions which are there. Okay. And with all the exam insights and everything which is given to you. So I personally like this book a lot. So just make sure that you all are also referring to it, and it gives you a very good impact on your studies. Each and everything here is so organized, and that's the best part about this book. You don't have to refer here and there. Just refer to this particular questions and the solutions which I'm making. All these solutions, can match with, whatever is there in your particular book. So ICAI Solutions, it's a very, very, very important book which you all should have from your examination perspective. Okay. Now, my dear students, let's continue this further for your May 25. Let's get started. Are you guys ready? Okay. May 25. Fine. Chalo, let's start. Now, see what is given to you. That in your question number 1A, what is available? The following information. So all my VIVITSU students, you will be getting all these questions in the book only, chapter wise. So you can just find all these questions and then practice on your own. And for others, you can just refer to all these things and which is there in your institute book, exactly your study modules, your suggested answers. So we have to take that suggested answers as a base and then do it accordingly. Fine. Chalo. May 25. Let's start. Question number 1A. What is given to you? The following information is available for S Limited for the year ended 31st March of 2025. Raw material consumed is 20% of COGS. Raw material inventory turnover ratio, that is 4 times. Always remember, all this inventory turnover ratio, etc. is always in times. Finished goods inventory holding period, that is 0.75 months. Gross profit based on COGS, that is 12.5%. Debtors collection period, all sales are on credit basis, that is nothing but 3 months. Proprietary ratio, what is proprietary ratio? Proprietor funds upon total assets. Fixed assets turnover ratio based on sales, and fixed assets to total assets is also given to you. You are required to prepare a balance sheet as on 31st March 25 in the following format, in which we have liabilities, shareholders funds, assume there is no preference shares, so entire shareholders is your equity shareholders, long-term debt and current liability. In your fixed assets, we have stock of raw material, then we have stock of finished goods, debtors and cash. So this is the format which is given to you. You have to prepare the entire balance sheet. How will you approach the question? See, in your ratio analysis, now approach to the question is extremely important. Okay. See, very simple. Always start where the figures are readily available. Now, my dear students, as you all can just check, you will come to know that yes, sir, in this particular question now, we have our fixed assets available, which is nothing but 12 lakhs. Now, fixed assets is 12 lakhs. You guys can just check. There is fixed assets turnover ratio given to you. So obviously, I will be able to find out what is the amount of sales. Come on, yes or no? Yes, sir. So see, the first ratio they have also started with is nothing but your fixed assets turnover ratio. So we have the fixed assets amount available. This is 3 times. We'll be definitely getting the amount of sales, which is 36 lakhs. Now, the beauty of this question is they have told you that your gross profit ratio is based on cost of goods sold. So how will you approach this? See, these small things are very important. In examination, you should not make a mistake in this. COGS plus GP will give you sales, right? Cost plus profit gives you sales. Now, what is your GP ratio? Your GP ratio is nothing but 12.5%. But it is based on your COGS. So this is 12.5 on your COGS. So let the COGS be 100. So your sales is 112.5. Now, do you have the amount of the sales available? Yes, sir. What's the amount of the sales which we got? 36 lakhs. Now, if I have the amount of the sales available, which is 36 lakhs, can I get my COGS? Come on, yes or no? Yes, sir. So I can simply take 36 lakhs, multiply that by 100, divide that by 112.5. I will come to know 32 lakhs. So this is my COGS, which is 32 lakhs, which will help me to get my GP, which is 4 lakhs. Okay. So you can simply take 32 lakhs and add 12.5% to it. Will be finally getting what? Your sales, which is nothing but 36 lakhs. So it's very important that what is going to be your COGS GP ratio that is going to give you your sales. Okay. Continuing further, what else do we have? So we have raw material consumed, which is very good, Krisha. I'm so happy. Please answer it like this only in the chat box. Okay. Now, what is the next thing which we have here? So once we have your sales available, okay, then we also have fixed assets to total assets available. So then we just have to substitute all the remaining things. So just check fixed assets to total assets will give you the total of the asset side, which is coming as how much? Which is coming as 30 lakh rupees. Okay. And then total liabilities will also be 30 lakh rupees. Okay. Then can we calculate your stock of raw materials? Come on, yes or no? Yes, sir. Which is COGS into 20%, because they have only told you that raw materials is 20% of your works cost of your COGS. So accordingly, we can get your raw materials consumed as well. And this is amount coming as 6,40,000. And stock of raw materials. Now, as you all can see that raw material inventory turnover ratio is 4 times. So in this particular case, can I put it like this? That raw material inventory turnover ratio is given to us 4 times. So whatever is your stock of raw materials, with that we can calculate what is nothing but your RMC. Because what is the formula for your, what is the formula for stock of raw materials? See, I'll just explain you like this. Let's say, for example, RMC, okay, raw material consumed. How much have they told you? That is 20% of your COGS. Okay, it's 20% of your COGS. So 20% of COGS which just now got, that is 32 lakhs. So we will now get what is your raw material consumed, 32 lakhs into 20%. How much is this coming? 6 lakh 40. Now, how will you calculate your stock of raw materials? So for your stock of raw materials, what's the formula? So can I say that when I have the turnover ratio available, raw material turnover ratio, okay. So raw material turnover ratio will be what? Can I say whatever is your RMC, I will divide that by my average stock of raw material, my stock of raw material. Okay. So now in this particular case, my turnover ratio is how much? 4 times. So this is 4. Okay. My RMC, I have it as 6,40,000. And let the stock of raw material be X. Is this data sufficient for you to calculate what is the stock of raw material? Yes, sir. How much is that? 1,60,000. And as you all can see, it's 1,60,000. And then we can substitute that in your balance sheet, as your stock of raw materials, and then do it accordingly. Okay. Then continuing further, we also have what is your debtors collection period. So debtors collection period, guys, same formula. We have debtors collection period. Now Krisha has asked, can we not do sales? No, beta. Here, Krisha, they have specifically told you that we have to take into consideration. Specifically, they have told you that we have to take into consideration your RMC. See, your stock of raw materials, na beta, they have to be valued at RMC. When it comes to your debtors, in that particular case, sales is very important. So it is important that which things are you valuing. If you are valuing raw material, RMC is important. If you are valuing finished goods, COGS is important. If you are valuing your WIP, then cost of production is important. So it is important that which stock you are taking into consideration, and based on that we have to do the valuation. Okay, so you cannot take sales for your raw material stock. Got it? We have to compulsory take RMC and do it accordingly. Okay, great, amazing. So then we'll be having your whatever is your debtors collection period, then fixed assets and all those things. Then you just have to substitute this, and finally you will be getting the entire balance sheet which will be completed. Okay, so stock of finished goods is taken into consideration on the basis of your COGS. Okay, then what is going to be your current assets, total assets minus fixed assets will give you current assets. And then the breakup of that, we can do it by preparing the balance sheet. So then we'll be having stock of raw materials, stock of finished goods, debtors, balancing figure, you can treat it as cash and do it accordingly. So the same thing what we're going to do on the balance sheet asset side, it's a very basic question. The only thing which was tricky here was raw material consumed was some percentage of COGS, and your COGS was not a percentage of sales. Your GP was not a percentage of sales. Your GP was a percentage of COGS. So we had to do that accordingly. Okay. So on that basis, we had to do all the necessary calculation. Fine. So this was your question number 1A. Now this 1B, oh my God, this 1B had actually taken lots and lots of students peace of mind. May 25 1B dividend decision question. They were finding it very, very, very difficult. Okay, but I'll solve it in the most easiest way. Okay, as compared to suggested answers also, so that you can get the answers very, very, very easily. Okay, and it will become very easy for you. Now let us solve this May 25. See, there are some questions now which will require time. So I want to solve those questions in front of you so that you understand the approach. I cannot just go through it. Some ratios now, debt collection period, etc. It's very easy. So all those things you can do it on your own. The tricky points only I'm explaining it. But some questions only are very tricky. So we have to understand the flow of it. So we'll solve it rather. Okay. See, Y Limited produces energy drinks in different flavors. Due to high demand of its product, the rate of return on its earnings is 25%. Okay. So what have they told you guys? That they are earning a return of 25%. Okay. So whatever is their retention, they can reinvest it and they can earn 25% returns on it. Okay. Whatever is their earning, you know, they are earning 25% returns. Currently, the company retains 60% of its earnings. So what is the current? What is the current retention ratio? So your current retention ratio is nothing but what? 60%. Okay. Continuing further, and it distributes the rest. Okay. So obviously your dividend payout ratio is what? Your dividend payout ratio is nothing but 40%. Okay. Continuing further, what have they told you? That the current P is 8. Okay. So what is your current P ratio? Your current P ratio is 8 times. And after that, they have told you that the EPS is 10 rupees. Your earning per share is nothing but 10 rupees. Okay. This is the data which is given. According to Gordon's model, what will be the retention ratio if the company wants to maintain the P ratio to 12 in the current year? Given that the expected rate of return for an investor is 20%. So what are they trying to tell you in the first part of the question? That what is the retention ratio? So what is going to be my heading? Calculation of retention ratio. What is my heading, guys? Calculation of retention ratio. So this is my heading. Okay, I have to calculate the retention ratio. So while calculating this retention ratio, there are certain things which are changing. First, maintain the P ratio 12 times. So P ratio which we have to maintain is 12 times. So guys, the current P ratio is 8. We are changing it to what? 12 times. That's the first. Second, the expected rate of return of an investor is 20%. So your KE, we are going to make it as 20%. Okay. Now, my dear students, we are required to calculate what is the retention ratio. My dear students, can I say P0 is nothing but what? What is P0? Can I say P0 is nothing but D1 upon KE minus G, right? And we want to find out the retention ratio, okay? But can I calculate my P0? Of course, yes. See, I can find out my P0. How can I find out my P0? You guys can just check that. Do I have my EPS available? Yes, sir. I have my EPS, which is 10 rupees. Now, my P ratio is changing to what? 12 times. So can I say that my market price, okay, my new market price will be what? What is going to be the market price per share? Whatever is my EPS, you multiply that by P ratio. My EPS was what? 10 rupees. My P ratio is what? 12. So what's the market price? 120. Fine. So my market price is 120. Now, my dear students, what is the expectation of an investor, KE, that is 20%. Okay. So can I write down this 20% as 0.20? Yes, sir. We can write down this as 0.20, 20%. Okay. And minus your growth rate. So ideally, what is left with you? Your D1 is left and your growth rate is left. Now, guys, if my retention ratio is going to change, then definitely my D1 will also change. Okay, so I cannot keep the existing dividend. Don't you think that my D1 is going to change with the change in the retention ratio? Come on, yes or no? Yes. So now in this particular case, what I am going to do here is that we will assume let the retention ratio be X. Let the retention ratio be X. So can I say that my 120 is the market price? Okay. What is going to be my D1? Okay, Krisha, very good. What is going to be my D1? Can I say my D1 is now going to be whatever is my EPS into payout ratio, right? Can I say EPS into payout ratio gives me dividends, right? So my EPS, which is available with me, that is nothing but how much? 10 rupees is my earning per share. So I will take this as 10 rupees. Okay. And 1 minus retention gives me my payout ratio. So I can take this as 1 minus X upon, because see, 1 minus retention is payout ratio. So if my retention is 60%, payout will become 40%, right? So dividend will become 10 into 40%, that is 4 rupees. So 1 minus payout ratio, will that 1 minus retention, will that give you your payout ratio? Come on, yes or no? Yes, sir. Your K is 0.2, but what about your growth rate? So growth rate, as you all know, is B into R, or I will put it like this, retention into ROE. Now, do I have the retention? Of course, yes. What's my retention? Is X. What's my ROE? What's the return which I'm earning? I'm earning a return of how much? It's mentioned here 25%. So I'm earning a return of 25%. So this I can write down this as 0.25. So this is 0.25x. So my growth rate is 0.25x. You must have learned this as growth is equal to B into R. Correct? Now, I will just have to calculate the value of X. So if I take this further, now my 120, if I multiply that by 0.2, so this is 24 minus 120 into 0.25. So that is 30x is equal to 10 minus 10x, right? So in this particular case, this will now become what? 14 is equal to, if this goes here, minus 10x plus 30, this will become what? 20x. So now what's your x? This is 14 divided by 20, that is 0.7. So this will be called as my retention, because I had assumed x as my retention. So my retention is 70%. So now, my dear students, once I have my retention, which is 70%, the first part of the question is over. What is the retention ratio? So I have got my retention, which is nothing but 70%. Very easy, guys. So I just have to take my retention ratio to be X. My market price, if my PE ratio changes, my market price is going to be 120. And then my growth rate will also change. So based on that, I've done the calculation and this comes as 70%. Okay. Next, if I continue this further, what is the second part? What is the expected price of the share after 1 year if Y Limited achieves the above mentioned target payout ratio? Now we have to find out the price at the end of year 1. So please tell me now, PE ratio is going to be 12, right? Now what is the formula for PE ratio? MPS by EPS. Now my PE ratio is 12. My MPS, I want to find out, okay, in such a way that my EPS is 10 rupees. So have I got my MPS as 120 rupees? Okay. But what's my growth rate? What's my growth rate? So my growth rate has now changed. What is growth rate? Retention into ROE. So I just got the retention of 0.7. Okay. And my ROE is 25%. So 0.7 into 25% is what? 17.5. So now to this market price, which is current market price, if I add 17.5%, will I get the price at the end of year 1? So 120 plus 17.5%. So that is 141. So if I want to calculate the price at the end of year 1, how will I do it? So whatever is the current market price, you simply add what is going to be the growth rate to it. So finally, I'll be getting what, beta? I'll be getting the price, which is nothing but 141. Okay, so that's how the price at the end of year 1 will be calculated. Okay, so that is coming as 141. And then, my dear students, what's the third part? The third part is, will there be any change in the retention ratio if the company wants to maintain its PE ratio as 10? Now, will there be any change in the retention ratio? Then the answer is absolutely yes. My retention ratio, if there is any change, if the company wants to maintain the PE ratio as 10, then definitely things are going to change. My retention will change. And here the expected rate of return of investor is 17.5. So in this particular case, okay, so Krisha has told me, sir, why we have not taken 1 upon KE? No, beta, because see, here the KE was actually given to you in the question. Na? When the expectations is not given to you, na, at that point of time, we do 1 upon KE to find out the PE ratio. But here in this particular question, na, here the PE ratio is given and the expectation is also given to you. Just check now, what is your KE in the C part? As you can see, the KE is what? 17.5%. Can you just check that? Your KE is 17.5. What is the PE ratio? The PE ratio is nothing but what? It is 10 times. Okay. Now we have to again find out the retention ratio. We have to find out the retention ratio. Okay. How will you do it? So now again, what is the market price per share? If my PE ratio is 10, then this will be 100, right? And then based on this, because if my PE ratio is 10 beta, can I say that EPS was 10 rupees, right? So EPS was 10, 10 into 10 will give me what? Market price of 100 rupees, right? And then my D1 is going to be what? My D1 is going to be earnings, which is 10 rupees into, let the retention be X upon, now the K is 17.5, so 0.175 minus, what is the growth rate? So my growth rate is retention into ROE. So what is my retention, guys? My retention. My retention is nothing but X and my ROE is 0.25. So this will now become what? 0.25X. So this is nothing but 10 into 1 minus X. Okay. So if I continue this further, 100 is equal to 10 minus 10X upon 0.175 minus 0.25X. So this will become what? 17.5 minus, this will become 25X, right? Is equal to 10 minus 10X. So now this will be what? If I continue this further, this will be what? This will be coming as 7.5 is equal to 15, right? So this is going to be 15X. So what is going to be your X? Your X is going to be 50%. So this is going to be 50%. So your retention is going to be 50%. So if you guys can just check in your answers, your retention is going to be what? 70%, as we just got it, 141, and here it is 50%. Okay. But we have to take it into consideration that the EPS is going to be constant throughout. That is the very important thing. Is your EPS going to be, Krisha, constant throughout? Come on, yes or no? Yes, your EPS is going to be constant throughout. That is something which you have to understand. Okay. Fine. Chalo, perfect. Now, this was your May 25 question number 1B. Many students found it difficult, but I hope you all have understood this now. Okay. And now let's start with question number 1C. If you want, now I'll upload this entire solution, whatever I'm solving, on my Telegram group. So you can just download that from the Telegram group as well. So don't worry about it. Okay. Chalo. Now, I'll give you the link of Telegram group in the description. Okay. You can take it from there. Now, following information relates to A Limited for the year ended 31st March 25. In this, we have profit volume ratio, we have operating leverage, we have financial leverage, we have interest expense, we have tax rate, we have number of equity shares. We are required to prepare the income statement for the year ended 31st March 25. Now, guys, this is a very easy question. In this particular question, what is required to be done is we have to prepare the income statement. So we are going to start with sales, variable cost, contribution, fixed cost, EBIT, interest, EBT, tax, and PAT. Okay, and divide that by number of equity shares, will be getting EPS. So now you must be wondering, sir, where is the sales given? Nothing else is given to you. But do we have the interest expense available? Come on, yes or no? Yes, sir. We have the interest expense available and we also have the financial leverage. So once we have the interest expense and once we have the financial leverage, can I say we can get the EBIT? Come on, yes or no? Yes, sir, we can get the EBIT. Then once we get the EBIT, operating leverage is there, we can also get the contribution. And once we get the contribution, we have the profit volume ratio also, we can get the amount of the sales. And based on all these things, Can I say we can get the entire income statement and do it accordingly? Come on, yes or no? Yes, sir. Also, EPS is what? NPAT divided by number of equity shares. That will give you your number of equity shares, earning per share. And then in the third part, they have told you calculate the percentage change in EPS if the sales increases by 5%. So how do we have to do that? In this particular case, which leverage will you use? There is percentage change in EPS and percentage change in sales. So I've told you that percentage change in EPS and percentage change in sales, we are going to use the formula of combined leverage, because combined leverage is percentage change in EPS upon percentage change in sales. So prepare the income statement normally only as we normally do it. Okay. See, if you guys are watching this in recorded way now, then you have to pause the video, solve the entire question based on this entire part, whatever we have discussed. Okay. We can take your, whatever is your combined leverage and whatever is the income statement and all those things, substitute all those things and then get the answer and then check it with the solution. Okay, so EPS is coming at 16.8 and it's a very easy way to solve it. Normal basic question on leverage was asked in this particular 1C. Okay. Now let's continue this further and proceed with your next question, which is your 2A. Okay. Now what is given to you? The capital structure of B Limited for the year ended 31st March 25 are as follows. We have equity share capital of rupees 10 each, 14 lakhs. Then we have 10% preference shares of rupees 1000 each. We have debenture of rupees 100 each. We have bank loan, which is 6,40,000. Risk-free rate of return is 14%. Market rate of return is 19%. And the beta of the company is 1.2. 10% preference shares are redeemable at 1065.4 after 3 years. And then they have told you interest on bank loan is 1.3 times of interest on debentures. Debentures are redeemable at par after 5 years. Flotation cost is 4 per debenture. Tax rate is 30%. Cost of capital is 14%. You are required to calculate cost of equity. How do you calculate cost of equity? Can I say CAPM model will be used? We have risk-free rate, we have market rate return, and we have beta of the company. So based on that, we can definitely calculate your KE. So we can calculate your KE using your CAPM normally only. Beta. As we normally calculated using CAPM, we can get the answer this as 20%. Okay, very easy to calculate. Second part. What have they asked you? Calculate of preferences using YTM. Now for YTM, do we have preference dividend? Of course, yes. This is 10% of rupees 1000 each. So 100 is the preference dividend. Life is what? 3 years. So immediately what should come to your mind is, yes sir, 1 to 3 years, my preference dividend is what? 1000 multiplied by 10%. So that is nothing but 100 rupees. That's my preference dividend. Krisha, I hope you're understanding. At the end of the third year, are we going to redeem this preference shares? Yes, sir. We are going to redeem it at what price? 1065.4. So we are redeeming this at 1065.4. Okay. And then, my dear students, we have to find out this by YTM. So we have to find out the IRR, where 1 should be greater and then discounting factor at some percentage, present value, and 1 should be less than the PV of CO. So what's the PV of CO? Let's check this out. We have the PV of CO, which is available. That is the market price of the preference shares. And since no data is given to you, the preference shares are issued at par, which is 1000 rupees. So this is going to be greater than 1000. This is going to be less than 1000. So you must be wondering, sir, what range should I take? So to take the range, they have given to you 10% and 14%. So I will discount it at 10%. I'll discount this at 14%. And once I get this, I'll be using interpolation. So you know how to do interpolation. It is 10% plus something. So the difference between 10 and 14 will be 4%. And in 4%, I need to check how much is the PV of CI getting reduced. And then what is the target PV of CI? We can do cross multiplication and we can use interpolation and do that accordingly. So that is your YTM method. Okay. Then what have they asked you next? What is the post-tax cost of debenture using approximation method? So what is approximation method? KD is equal to what? Interest into 1 minus tax plus. What we need to take, beta? RV minus NP upon N, which we have to divide by taking what? RV plus NP upon 2 into 100. Right? So this is approximation method. Now for this, do you have your cost of debt? Yes, they have told you. What have they given to you? That for your debenture, let us read. Debentures are redeemed after 5 years. Flotation cost is 4. So your net proceeds is going to be 96. Okay, remember that your net proceeds is going to be 96. Redemption is going to happen at par, that is 100 rupees. And what is the rate of interest? So then for that, do you have the rate of interest? Debenture at 100 each is 9,60,000. You don't have any rate right now given to you. risk-free rate is 14%, beta 10% preference shares, interest on bank loan is 1.3 times interest on debentures. But we don't have the interest on debentures right now. They have told you that the cost of capital is going to be 14%. Okay, so this is the data which is given to you. Now, how do we take into consideration? Okay, so in this particular case, my dear students, we have to assume that your interest is going to be X. Okay, so Trisha is asking one doubt. Okay, sir, I had a doubt on how to know if put percentage in the calculator in these questions. Sometimes there are errors. Okay, I'll tell you what we have to do that. See, first of all, my dear students, we don't have any interest on the bank loan, but we have weighted average cost of capital. So can I say that we have the total amount of KO which is coming as 14? Okay, so we have the KO which is available as 14, and we have different types of instruments which is given to you in the question. So we can calculate the weights first, and once the weights is calculated, we have to multiply that by after tax cost so that the WACC comes as 14. Okay, but it is important that how do we have to take into consideration, how do we have to calculate that cost? Okay, so calculation of interest rate. Now let the rate of interest be X. Okay, so we are assuming that interest rate. Okay, yes. So one student has asked doubt, is a present value means your IRR? Yes, it means your IRR, and then we have to do that accordingly. Okay, so basically we have to discount it and then we have to convert it into present value terms. So present value method mein what we have to do is beta that we have to take a range and do it accordingly. Okay, so we have to take a range. So we are taking two discounting factors of 10% and 14%, and then we are calculating a range and then we are doing it accordingly. Okay, now see guys, this working is very important. We don't have here the rate of interest on debentures given to you, so let the rate of interest on debentures be X. Now that is something which we have to assume. Okay, so if your rate of interest is going to be X, can I say that for your banks it should be 1.3x? Okay, see, on debentures, what is your rate of interest? On debentures, your rate of interest, we are assuming it as X. Okay, because they are not given to you what is the coupon rate, so we are assuming that as X. So for bank loans, what have they told you? Hey, sir, for bank loans now, they have specifically told you that, hey, sir, we have a rate, they have specifically told that 1.3 times of the interest on debentures. Okay, that is 1.3x. But guys, this 1.3 is pre-tax. We want it post-tax. So what we have to do? 1.3 into 1 minus, what's the tax rate? The tax rate they have told you is 30%. So I will take 1 minus 0.3x. So 1.3 into 0.7, that is nothing but 0.91x. So now do I have my bank loan interest rate? Yes, sir. Do I now have the coupon rate here available, which is nothing but X? Come on, yes or no? Yes, sir. Now, how should we take into consideration? So see, this is already in percentage terms. Okay, I'm assuming this X as percentage term. So in my formula of KD, where I'm going to take interest into 1 minus tax, can I say that this interest is nothing but face value into coupon rate, and coupon rate is X, right? So what's my face value? My face value is 100 and my coupon rate is X. So this has to be 100x, right? So if suppose this X is 10%, so what we used to write down? 100 into 10%, that is 10. But I'm assuming that this coupon rate is X, but this X is a percent. So what is going to be my interest? My interest is going to be 100 into X. So that is why 100 into X is going to be the interest. I'll explain you this again. See, if it is 9% debentures of face value 100. So what's the interest? 100 into 9%, that is 9 rupees, right? Now I am assuming the coupon rate itself as X. So this is, I'm assuming this as 9% as X. So in that particular case, what is going to be the interest, guys? Can I say face value is 100? You simply multiply that by X. So can I say that will be 100x? So my interest has to be 100x. Come on, yes or no? Yes, sir. You guys can just check. Your interest is 100x. You got it? So 100x is going to be your interest. So this is something which you have to understand beta very, very, very thoroughly. That we have to assume the coupon rate to be X. So 100x is the interest of that part. into 1 minus tax plus 100 minus 96 upon 5, you do the calculation. So you'll be getting your KD as 70x plus 0.8 upon 98. And already we got bank loan as 0.91x. Then we have to multiply that by weights and get the total. And this total has to be 14. So then what we have to do is 0.14 is equal to create an equation where this is 0.07, right? Because they have taken this in decimals, right? Here, instead of 14, they have taken as 0.14. They have not multiplied anything by 100 here. So when they have not multiplied by 100, what does it mean? That they have kept the decimals. So this is 20%. Instead of 20%, they have written 0.2, right? Can you just check this? This is 0.2. Then they have kept 0.12. So they have not multiplied that by 100. So this total also has to be what? 0.14, right? And based on this, my dear students, they have calculated, they have created one equation of 0.14. They have found the value of x. And once they have found the value of x, that is interest on debentures, we automatically got the KD as 9.939. And then we got the interest loan. So this question, rather than more of finance, it is more of mathematics. Okay. The institute is checking your mathematical capabilities. And it's very sad to know that if we have the total amount and if interest rate, we have to find out, there is actually of no use in finance. You always have to calculate. You will always know what is the weighted average cost of capital by considering what is the interest rates, etc. But we cannot challenge what institute is asking. So we have to take that into consideration and do it. Okay. So that's how, my dear students, will be taking into consideration your X and then solve it accordingly. Okay. So with this, my dear students, we are done with your question number. This is your which question, beta? This is your question number. Question number 2A. Okay. I hope you have understood how do we calculate it. Okay. So in this particular question number 2A, what was missing, beta? In your question number 2A, actually the missing part was we did not have the interest rate only. So we had to assume the coupon rate as X and then do it accordingly. Okay. So we did that, and then we had the total WACC of 14%. So we created one equation, and based on that, we did the calculations. Okay. Chalo. Now let us do your question number 2B. In your 2B, what is mentioned? Following details are related to H. We have EPS, we have ROI, we have KE. As per the Walters model, what is the maximum and minimum price per share? Wow. Can I say that your R is greater than KE? So your optimum payout ratio as per Walter should be what, beta? It should be 0. Your optimum payout ratio should be 0. Okay. So based on that, we have to do the calculations. Okay. So if we keep the optimum payout ratio 0, then we get the price of 26.67. But minimum price is what? That we give 100% dividends. So in that particular case, what's the minimum price? That will come as 20 rupees. So it's a very, very easy question. And if you can get it exactly, this is 3 on 3. Optimum payout ratio plays a very, very, very important role here. Chalo. Now let us continue further with your question number 3. In question number 3, see what is given to you. In question number 3, they have told you that, let us start. Okay. So this is on capital budgeting. Question number 3A, investment decisions. Following is the data which is given to you for a particular project, in which we have annual interim cash inflows for the first 2 years. Then we have annual interim cash inflows for the next 2 years. Useful life is 4 years. Salvage value at the end of the project is rupees 50,000. Internal rate of return, cost of capital. We are required to calculate what is the initial investment. Guys, how will you approach this question? Now see, can I say that at IRR, PV of CI is equal to PV of CO? Do you all agree with this statement? Right? Now, do I have my IRR rate? Of course I have, which is nothing but 12%. Okay. If I take here 1, 2, 3, 4, 5. If I take my cash inflows, what are my cash inflows? Can I say for the first 2 years, it is nothing but 1 lakh. Okay. So this is 1 lakh, 1 lakh. Okay. Then what have they told you? For the next 2 years, it is 80,000. Okay. This is 80, 80. Sorry, the life is just 4 years. And at the end of the 4th year, are you receiving any salvage? Yes, that is 50,000. Now guys, if I discount all these things at my IRR percent, now what is my IRR percent? Let's check it out. Your IRR percent, which they have told you, is nothing but 12%. Will I get my PV of CI? Come on, yes or no? Yes, sir, I can get my PV of CI. And once, my dear students, I get my PV of CI, this is going to be my PV of CI. At discounting factor 12%, if I get my PV of CI, can I say at IRR, my PV of CI is going to be what? Equal to PV of CO. So once whatever is the PV of CI, that will be equal to my PV of CO, and accordingly I'll be getting the internal rate of, I'll be getting my initial investment. What about my net present value? So for my net present value, what's my cost of capital, guys? It's 10%. So then I'll be discounting everything on the base of the 10%, and I'll be getting PV of CI. So same table I have to prepare again, but now my discounting factor is going to be what? 10%. Okay. So as you guys can see the solution. Okay. First I've done it for 12%. So it's coming as 3,08,640. Then I've done it for 10%. So this is coming as NPV 13,730. Okay. And then my dear students, they have asked you what is profitability index. So it's PV of CI upon PV of CO. So that will be coming as your 1.0445. Okay. And then what is discounted payback period? As we have already discussed, my dear students, discounted payback period is what? That whatever is the cash flows, we have to discount it, we'll be getting the PV. Take the cumulative present value of cash inflows and then check between which 2 years is your PV of CO getting recovered. And based on that, we'll be getting what is your discounted payback period. It's actually a very lengthy question, but very easy to solve. Okay. And then last part is modified internal rate of return. So for MIRR, what can we do? For MIRR, can I say that whatever is the cash inflows, we have to reinvest it. And we reinvest it at your 10% cost of capital. So then we'll be getting the terminal value of the cash inflow, which we are going to receive at the end of the 4th year. But here we also have to understand that salvage should be forming part of the cash inflows always. Okay. So in your cash inflows, we'll be reinvesting it. Okay. And then we'll be getting whatever is the present value. Okay. And then the terminal value, whatever you have got, we have to discount it and we have to bring it to the present value term. So do we have the factors available in the question? Come on, yes or no? Yes. Then we can use interpolation and do it accordingly. Or else there is one more way to solve it. So I'll teach you that one more way as well. Just check what's the terminal value which you have got. The terminal value which you have got is nothing but 4,72,100. Okay. So your terminal value is coming as 4,72,100. Okay. After doing all the reinvestments for MIRR. Yes. So for MIRR also, salvage should always be taken, Krisha. See, whenever the salvage is given to you now, just check for NPV, for payback period, for discounted payback period, for IRR, everywhere, for MIRR, everywhere the salvage is taken into consideration. Okay. Now, what is the terminal value which I have? 4,72,100. What is the PV of CO? Let's check this out. What's your present value of cash outflow? We would have got it from the first part. The present value of the cash outflow is 3,08,640. Okay. So this is nothing but 3,08,640. Now, can I say amount is what? Principal into 1 plus I raised to the power n. Now, amount is nothing but 4,72,100. Principal is what? 3,08,640 into 1 plus I raised to the power 4. Can I say the moment I do this, 4,72,100, divide that by 3,08,640, I am getting this as 1.5296. This is 1 plus I raised to the power 4. If I take the root 2 times, I'll be getting 1.1121 is 1 plus I. And if I take 1 year, this is 0.1121, or can I say 11.21%? What is 11.21%, beta? Can I say this 11.21% is nothing but, you guys can just check MIRR. And they have also done it alternatively the way I have done it here. As you all can just check, it is 11.21. That is nothing but MIRR. So you can do it in this way also. Whatever is convenient, you can take that particular method and do it accordingly. So your MIRR will be coming as 11.2. Okay. Chalo. Next question, B part. In the B part, now this is a textbook question and I'm very sure you must have done this earlier also. What is given to you? That Z is an unlevered company. Now this is MM with tax. Now for MM in tax, what are certain rules which you have to remember? The first rule is, sir, whenever there is MM with tax now, we have to convert. First, we have to understand that market value of levered company is always greater than market value of unlevered company. Now, this market value of levered company is always greater than market value of unlevered company to the extent of tax savings which happens on debt. Okay. So, what is the formula in that particular case? Can I say that market value of levered company is nothing but market value of unlevered company plus debt into tax rate? Okay. You have to understand this, that this is the concept of your MM approach with tax. So Z is an unlevered company. It wants to repurchase its equity shares of 300 lakhs by issue of 12% debentures. So Z was an unlevered. Now it is planning to get converted into a levered company. So definitely now Z will become levered company. So its market value is definitely going to be higher. Current market value of unlevered company is 1400 lakhs. Its cost of capital is 18%. So that's your KO. And the company will maintain the same level of EBIT in futures. Dividend payout is 100%. Company's tax rate is 30%. As per due to a change in capital structure, what will be the impact of market value of Z, overall cost of capital, and your KU? So three things which are required to be calculated. Okay. And that is after change in capital structure. That is after we get converted from unlevered to levered. So the first thing what you have to do is we should prepare an income statement. EBIT minus interest. What do you get, guys? EBT minus tax. What do you get, guys? NPAT. Can I say this NPAT is nothing but dividends, right? So first it was unlevered. Now it is planning to get converted into a levered company. How should you approach the question? Now, do we have current market value of Z? Yes, sir. What is the current market value of Z? Market value of company. That is nothing but 1700 lakhs, right? And sorry, how much is it? 1400 lakhs. Sorry, it's not 1700, it's 1400 lakhs. Okay. And then what is the cost of capital? 18%. So its KO is 18%. Okay. Now please tell me that, of course, because there is no debt in the capital structure, its K is also 18%. And your market value of equity itself is also 1400 lakhs. Can I get the dividend? Come on, yes or no? Yes, because what's the formula for K? Dividend upon market value of equity into 100. What's my K, guys? 18. My dividend, let it be X, and this is 1400 lakhs into 100. So in this position, can I get my dividends? Come on, yes or no? Yes, 1400 into 18. Divide that by 100. So it gives you 252. Now I am going to have my dividends, which is 252. I have to go reverse, get the EBIT. Now just check what is the tax rate which they have told you, 30%. So if this is 100, this is 30, this has to be 70. Can I get my EBT? Yes, sir. 252 into 100, divide that by 70. So that is 360. There is no interest. So this is 360. So your EBIT also has to be 360. But now, my dear students, we are taking debt. How much is the debt? We are taking debt of 300 lakhs at the rate of 12%. So 300 lakhs at the rate of 12% is 36. So from 360, if I subtract 36, this is 324. And then minus 30%. So this is 226.8. Now I have all the data available for levered company. That is when this particular company will be introducing debt in the capital structure, when it will be become levered company. I have this as 226.8. Now what we have to calculate market value of Z. How do you do that? So in this particular case, to calculate the market value of Z, we have to take into consideration unlevered company value, which was nothing but 1400 lakhs plus debt. Debt is what, beta? Can I say debt is 300 lakhs? Okay. And multiply that by the tax rate. What is the tax rate which you have? 30%. So in this particular case, can I say I'll be getting 300 lakhs into 30% plus 1400. So it has to be 1490 lakhs. So my dear students, just check the solution. Are you having 1490 lakhs? Yes or no? Yes, sir. Also at the same time, what is the change in the market value of the company? Then it's 90 lakhs. Then what is the overall cost of capital? So for overall cost of capital, first we need K. So K will be what? Dividends upon market value of equity into 100. So for dividends, we have already done it in the income statement, and market value of equity is nothing but market value of the firm minus debt. So you will be getting market value of equity. And once we get the market value of equity available, dividend upon K, upon whatever is your market value of equity into 100, you will be doing it. You'll be getting the K also as 19.06. Okay. And then my dear students, overall cost of capital can also be done accordingly, which is nothing but 16.93%. And then they have just done one small analysis that always when the company is going to be converted from unlevered to levered, your market value of the company is going to increase, your K will decrease, will also increase, and your overall cost of capital is going to decrease. So these are the important aspects to it. Okay. Then question number 4, what is the agency cost and what are the types? How can a company minimize the agency cost and align the interest of the manager and the shareholder? Okay. Now this is the next question which we are going to solve, which we are going to understand. So this is a theory question. So see what is given to you. Agency cost means what? Agency problem is the chances that the managers may place personal goals ahead of the goals of the owners. So that is the problem of agency cost. See, now let's say, for example, if I am an entrepreneur, but if I appoint a CEO, the biggest risk is what? That he might place his personal objectives before the company's objectives. So because of which the problem is what? That there is a possibility that the company can run into losses. So when I am appointing an agent, who is doing business on my behalf, can I say there is a risk attached to it? Come on, yes or no? Then the answer is absolutely yes. So agency problem leads to agency cost, and agency cost is the additional cost borne by the shareholders to monitor the manager and control their behavior so as to maximize the shareholders' wealth. Okay, so there is definitely going to be some problem attached to it. So generally, agency costs are of 4 types: monitoring, bonding, opportunity, and structuring. So following effects have to be made to address the issues to minimize the agency cost and to align the interest of manager and equity shareholders. So we have to tell him that there is no personal objective. We have to take into consideration what is going to be your, together, whatever is going to be the cost, we have to take that into consideration. So we have to take the equity shareholders objective also, and combined put together, we have to take it into consideration. So here what is given to you, just check. Following efforts have to be made to address the issue. Managerial compensation is linked to the profits of the company. Okay. So what we can do is now, whatever is the long-term objectives of the company, align the manager to that. So he will definitely work towards the interest of the equity shareholders. Okay. So employee is also designed to address the issue for maximization of the profits. Then monitoring effects can be done and all those things. So we can always have a check on whether the manager is setting up the goals which is in interest of the equity shareholders. Okay. So your manager should always be assigned or aligned with the interests of the equity shareholders. That is very important. Okay. Then what are the features of bridge financing? So bridge financing means what? Very simple concept. Suppose I want a loan today of 100 crores. A bank told me, okay, you can get a loan today for 100 crores, but we will take at least 4 months to dispatch that loan. So for the period of 4 months, I go to someone and I take the borrowings from that, and I tell them that I will repay you the loan the moment the bank gives me the money. So that concept is called as bridge financing, because the opposite person is giving me loan for a particular period of time, right? So basically if it is 0, okay, so then in that particular case from 0 to 4 months, that much period of time, we are going to take it into consideration, the time period for which we are going to take the loan, and based on that, then accordingly, we have to take into consideration some other a part of the loan apart from that. So that will be called as bridge financing. So apparently what we have to do is, let's say for example, I need a loan after today only, but the bank is dispatching after 4 months. So from 0 to 4 months, there is a bridge. So this bridge financing will be taken into consideration with the help of this. See, it refers to the loan by a company normally from commercial banks for a short period because of pending disbursement of loans sanctioned by financial. The bridge loans are repaid adjusted out of the term loans as and when disbursed by the concerned institutes. So they are normally secured by hypothecation of movable assets, etc. Okay. Then what is the hierarchy of financing pecking order? Okay. Now let us understand this. Pecking order theory suggests that managers may use various sources for raising fund in the following order. Managers' first choice is to use internal finance. In the absence of internal finance, they can use secured debt, unsecured debt, hybrid debt, etc. And managers may issue new equity shares as the last option. So this hierarchy of financing pecking order exists to minimize the cost of capital, financing control, and avoiding negative market. So pecking order means what? That what is the way in which we should raise the fund. So first option is use your own reserves. Second is we can take into consideration secured debt, okay, unsecured debt, etc. And the last option is what? That we can take into consideration issue of equity. So why is debt preferred over equities? Because you can get the benefits of trading on equity. You can get the benefits of tax savings. We can have higher increase in EPS, and all those things are possible when we are taking into consideration financing pecking order. Okay. Then, my dear students, we have something which is called as combination of degree of operating leverage and financial leverage. So what is operating leverage? If it is low, financial leverage. If it is high, what does it mean? It means that there is moderate total risk and best combination. Okay. But if operating leverage is high, so it's not a good combination. And if both of them are high, it's definitely not worth it. Okay. So always remember that if operating leverage is low now, then it's fine. Okay. Whenever the operating leverage is low, always remember that If the operating leverage is low and the financial leverage is high, what does it indicate? It indicates that we have to take into consideration, your final, business operations are considered to be good. It is considered to be moderate, and we have to take that into consideration. But if your operating leverage is very high and your financial leverage is low, then that particular case is still okay. But if both of them are high, then we should not take that into consideration. Okay, so this is something which you have to understand when we are going to deal with your combination of leverages. Okay, so with this, my dear students, we can complete your which paper, guys? We have completed now. We have completed May 25. Okay, we have completed May 25. Now, my dear students, if you just check, your May 25 is also done. Okay, now there is September 25. There are 3 papers which are remaining now, which I want to do it. That is September 25, Jan 26 and May 26. Okay, now see, September 25, then we have Jan 26, and then we have May 26. Okay, we have 3 papers which are left now. Okay, and how many papers we did we do? We started with May 24. We did after May 24 your September 24. Then we did Jan 25. Okay, and then we did May 25. Okay, so my dear students, now what I will do is, now this video, okay, because see, Jan 26, May 26 will require more questions to be solved. Okay, so if I am going to do it now, this Jan 26, May 26, if I do it right now in this particular video, now it will take again 1.5 or 2 hours to complete this particular part. So let us fix up one thing. Let us meet tomorrow. Okay, I will share the link in the Telegram group, in my Telegram group, where I will be doing these 3 papers then. Okay, so these 4 papers will be relating to this video. These 3 papers we will do it, in our next video, in our part 2. Okay, so I will share you the link in my Telegram group. Okay, and I will just give you the name of my Telegram channel also. But before that, now you can just take this contact number 7700936039. You can WhatsApp me here. Okay, for any doubts, for any difficulties, or also at the same time, if you want any further updates or something. And then what we will do now, we will have one more video. We'll have one more session for these 3 papers exclusively, and we'll complete both these things then together. Okay, so part 1, we completed these 4 papers. I hope you all have understood, you all have gained confidence, you all have learned something new, and all these questions we have completed. Okay, but again I am repeating, I will be also doing in this part 2 only practical questions and theory. If you want also MCQs, or if you want MCQs for all these papers now, then do let me know. This MCQs now, I will be solving it. I'll be solving all these MCQs and giving you a recorded video for the same. But for that, you have to comment MCQs for the video. So I will definitely give you MCQs for that as well. Case studies and MCQs for that as well. Okay, for all these papers. Okay, and then we can proceed accordingly. Okay, guys. But it is important that you all have to be in touch. Okay, keep on studying properly. Tomorrow we will have one more video for these 3 papers, and then we will continue further, because I don't want the video to be very long. Okay, these 4 papers we have completed in this video. In the next video, we'll be completing these 3 papers. Okay, now there is one doubt which a student has asked. So first I'll complete that doubt. Okay, sir, can you please explain cost of capital, market value, WCC? When do we take retained earnings? Okay, see, Krisha, if K is not equal to KR, in that particular case only in market value weights, we have to take retained earnings. When KE is not equal to KR, and when is that possible? When there is flotation cost given to you in the question. So whenever there is flotation cost which is given to you in the question, now your KE is not equal to KR, and when KE and KR both are not equal to now, then in that particular case, what we have to do is, we will take into consideration, when K is not equal to KR, we have to take into consideration your reserves and surplus market value weights differently. And we have to take, equity share capital also. Okay, and we will do the bifurcation on the basis of market value of equity and do it accordingly. But for that, K is not equal to KR. Only on that basis, we have to take it into consideration. Okay, understood, Krisha? So my dear students, WhatsApp me on this particular number if you have any doubts, difficulty, if you want any links, video links, etc. So my team will also get back to you and they will provide you with necessary updates on the same. Okay, you can join the Telegram channel, okay, where I'm uploading the MCQs also, and we can take that into consideration as well. Okay, but my dear students, for today we'll be winding up the video. Okay, one more doubt I've received from Krisha is, yes sir, other students we ignore retained earning when K and KR. Yes, we ignore retained earning. In market value weights we ignore it. Okay, so we'll put an end to today's lecture. Okay, so I hope you all have enjoyed it. Do share it with your friends. Okay, and then I will in your comment section also write down your views. How did you find it? And if there is any other data, any other videos which you want, then do let me know. Entire theory video is also uploaded on the channel. Revision is also uploaded. So you can take all these things into consideration also for your preparations. So that's it, my dear students. See you guys tomorrow. I will soon update to you by tonight, 10 or 11 p.m. What is going to be, to all the VIVITSU students also will be updating it, that what is going to be the next video, and then you can take it into consideration. Bye guys. Take care. Have a good night. See you.